welcome to Yahoo Finance's Morning Brief. I'm Julie Hyman, joined today by Zach Guzman, Trustless Media founder, and Yahoo Finance's Jake Conley. And we have been spending the morning reading because it is an extraordinarily
very busy
morning as we try to sift through everything that's going on. So thank you for your studying in advance of coming here to talk about it today.
Of the required reading.
Let's start with bank earnings here, because this morning we had JP Morgan, Bank of America, Goldman Sachs, Wells Fargo, and Citigroup all reporting their numbers. And for me, there are a couple of takeaways, but perhaps the biggest one, or the most consistent thread across all of them, is like equities trading is killing for these banks, which is very interesting and perhaps not surprising given the bounce back that we saw in the markets in the quarter, the volatility that we saw, and just that even when stocks in the U.S. have not been rising, they've been thundering. Like there's just been a lot of volume and a lot of action.
That's right.
These banks are benefiting.
That's right. Zach, I keep thinking about, I brought this up in the last hour, I'm going to bring it up again. I keep thinking about a statement from David Solomon back in June where he says, there is more greed than fear in the market. And I would love to get your take on that right now, seeing the bank numbers, everything else going on. Where do you sit on that?
I think that's always lean on DJ Diesel to deliver a good little quote like that. But I think that's true. And I think it is also, the market seems to be parsing out a little bit of how big these reports were in terms of what they can really sink their teeth into. Because for me, I mean, the quarter from JP Morgan, we can get into this, the one-time Visa payout there is kind of like, okay, how much of that is too much? And we were talking about this on Friday, is what are the reactions to these going to be? I don't know about you guys, but I'm a little surprised. A little bit more muted than I was thinking in terms of how big these results were.
So let's run through this for a second. And again, just to emphasize the equities revenue one more time, I know I'm fixating on this a little bit. Goldman equities revenue was up 72% to $7.42 billion. Equities revenue at JP Morgan up 86%, which is bonkers. At Bank of America, up 70%. So, and at Citigroup, up 45%. So just incredible increases. But when you get increases like that, inevitably the question becomes, can you do that another quarter? And the answer is usually no, not at that kind of torrid pace. So I think that's part of perhaps what we're seeing. The other part of perhaps what we're seeing, and I think the folks at Bloomberg were pointing to this, for JP Morgan, they are spending more also, which is interesting. So JP Morgan's new full year cost guidance is $107.5 billion. And that is higher than the company had talked about. And Diamond said this is because of higher volume and revenue related expenses driven by the activity levels and associated revenue outperformance. I don't know what that means, except you got to spend money to make money. I think that's what that means in human words. And
there is power in size.
Yeah, exactly. So I think that's what we're talking about, but that might be one of the reasons that we're seeing the stock.
I think that's the general takeaway. I think it's a bit of like a, if it's too good to be true, it probably is situation, just in terms of how much, to your point, how much can they keep that up. But just looking at it across the board, it's just incredible. And like you said, I wonder how much of this too can be kept up. We talked about this on Friday too, Jake, when we were thinking about SK Hynix and that coming to market right after a SpaceX and how much demand is still there. I mean, I think, going off these numbers, the market seems to be saying, it's a one-time situation.
Well, and the other thing, by the way, that is not necessarily repeatable at the same pace is the investment banking revenue, because we saw the SpaceX IPO. And how many underwriters and sponsors did that thing have on it?
20-something?
I think it was like 16 or
17?
It might have been 20-ish. Yeah, it was a lot, in other words. Everybody on Wall Street got a piece of that. And so that's now showing up in these reports. You have an uptick in mergers and acquisitions activity. And yes, even though we expect Anthropic at some point, OpenAI maybe this year, maybe not, that stuff that also is not going to be immediately repeatable.
That's right. Goldman also got to lead the Alphabet equity raise, another thing that's probably not going to be repeatable. But on Goldman, Zach, to your point on SK Hynix, Bloomberg reporting that one of the drivers of the equity revenue were investors' bets on Asian tech companies. SK Hynix, Samsung, Taiwan Semi. So there too, you've got to ask the question of, with what we're seeing in the market right now in the rotation, how much of that is going to be repeatable next quarter?
I mean, from just a general vibes perspective as well, it just seemed like, planning for today's show, which is packed, you got the bank earnings and everything else, and you're seeing the reaction there, but then you also had kind of everyone waiting for the CPI print and what that was going to be. Seemed like a general exhale, so much clenched muscles right now, what's going to happen, and then you had that cross, and it was a little bit of a breather, I think, for the market, and now we'll see how it closes on big earnings day, but a strong start.
Yeah, I want to just zero in on Citi for just a moment and just give it a little bit more detail, because this is a stock that is trading at its highest, I think, going back to the financial crisis now. And under the leadership of Jane Fraser, has really tried to turn the bank around. And this is another quarter that shows that seems to be happening, right? At least in pretty broad measure here. So the stock has come down a little bit from that multi-year high. It closed there on June 22nd, which is a time when a lot of the market peaked, including the semis around that time. But now you're looking at banking, services, markets, and wealth all beating analyst expectations. Within Citigroup, earnings per share were $3.15, which is better than any of the analyst estimates. So you see here again, Citi coming back. I mean, likewise, Wells Fargo, very different situation, but one that is an attempted comeback.
Right.
It's not as consistently successful a comeback. But Charlie Sharp spoke explicitly about that in the release and saying, like, we've had this cloud over us and now we're trying to move forward here. By the way, their revenue from equities trading was also up 45%. So
right.
they got a piece. You know, they're participating, I guess, is what I'm saying when it comes to Wells Fargo, and they're able to benefit more from the other stuff that the banks, the other rivals had been benefiting from all along. But its shares are down this morning too.
Right.
Yes, it's more
Citigroup also, Jane Fraser puts out new profit targets in May that looked optimistic. Shareholders responded as such. Now they're hitting those targets. That is a really big feather in the cap of Jane Fraser.
Yeah, it feels like it.
You mentioned Sharp too. I saw Ozzy tweeting about kind of the difference between how JP Morgan and Wells Fargo tackle their earnings calls when they talk about cost cutting versus money making. But I think the other big takeaway here is just kind of what Sharp said around consumers as well, which is, I think generally you've got very strong elements that we just talked about in the bank-specific earnings reports, but also from the consumer side, like the actual underlying economy, still promising signs there. Sharp calling out higher spending and charge-offs and delinquencies being lower as well. So I always like kind of getting a better sense of where the consumers are through the bank earnings as well.
Yeah, David Hollerith, who covers banks for us, predicted there would be a lot of resiliency talk in here. And there is some. It's not a huge amount, but you did get in some of the statements. And I'll be asking him after he listens to all those calls.
Yeah, it's
I'll
busy
be
time.
doing a little word search here once the calls are done. Let's get to another company, because this is one of the things that we're seeing maybe also put a damper on things this morning, and that is IBM. IBM is due to report its earnings, I believe, next week, or it's not. It certainly wasn't due to report today, and it's come out now with preliminary revenue that rose 1% to $7.2 billion. The problem is the estimate was for $17.9 billion, and those shares are falling some 20% here this morning. In the statement, we got an explanation for what is going on here. It was basically a letter to the employees of the company from Arvind Krishna, and he said, basically it seems like three things are affecting IBM here. They're rolling off this mainframe computer cycle that they had, Z17, like they're lapping the intro of that. So they were expecting a fall off, but it's worse than estimated because their clients are spending CapEx not on the mainframe, but on stuff where they expect prices to go up. So we're talking about servers and storage and memory. Exactly. So that's one thing that happened. Secondly, with the release of Mythos, there's a lot of concern about cybersecurity. So there's spending going there instead. And thirdly, the company talks about execution problems, that there were large deals that didn't close. So the question becomes, is this an IBM problem? Or is this an everybody problem? And it feels like those two first things could be an everybody problem.
I'd be more in the everything and everyone camp here of what we heard from IBM. However, you could take the other side in terms of what we were talking about on memory and kind of, to your point, Julie, kind of getting ahead of what may otherwise be continued price increases around everything that everyone wants to scoop up right now. And I think there is an element to that where we could answer the question we were talking about last week, which is how much is too much in terms of excitement around memory and everything else with SK Hynix coming out. And I would say that would be a bullish sign in terms of companies cutting money being spent on software and everything else that we heard in this warning, would be that continued strength in people wanting to buy memory and other things.
The other stuff.
Right.
Yeah.
Right.
Well, and by the way, IBM also sells servers, right? So even as they were maybe hurt on this side, they were helped potentially on the infrastructure side. So we'll see how, when they report the full numbers, we'll see how that looks.
That said, stock down 21% in the pre-market right now. Market absolutely hating the note from CEO Arvind Krishna.
Yeah, they're due to report, by the way, after the bell, I think after the bell on July 22nd. So that's when we will get a more full picture of what happened. We'll get commentary.
Basically a week from today.
From the company, right. We'll get that a week from today. But, it'll be interesting to see, again, what the implications are for the rest of the space. Because if the implication is that, okay, well, there's more spending on things like memory, you would think are the memory chip makers going to be up today? We're seeing a little bit of a bounce in a Micron, for example, here this morning, but that also just could be because they've been down a lot lately.
I was looking at other things too. I think a lot of the excitement around IBM and some of the other players like a Cisco, you see a lot of legacy tech names catching a bid this year around some of the excitement on chips and whether or not they can all of a sudden become AI giants as well. I think particularly for an IBM, you have a smaller margin for error if you get anything wrong.
Well, listen, IBM's an OG AI with Watson, right?
That's right. That's right.
And they now got a quantum. They've had quantum, but they're doing more quantum in cooperation with the government. So they're trying to strike that whole. As they should,
as I would if I were in their position too. But you got to get it done. You got to bring the goods if you're going to try and do that too.
Right.
The other problem.
Yes. Well, we'll see if this is just a one-quarter one-off, or if they expect some of that to start to correct in the coming quarters. But the tech trade lately, if we could just say a quick word about the tech trade lately, because it has been not great.
Yeah.
And so we go into this beginning of the earnings season, which unfortunately doesn't give us we got to wait a little bit for the big tech giants. But in advance of that, it does feel like we are on shiftier footing underneath than we were during the last earnings season to some extent.
It also opens up the question for me, if this is what IBM is saying about consumer spending, how they are spending their money, I'm going to be very curious to see what the hyperscalers, what the Mag 7, what the big tech leaders say about where they're actually putting capital. We've seen the CapEx targets just exploding. Morgan Stanley was raised yesterday its call for CapEx in 2027 from those companies to well over $1 trillion. So where is that money actually going, especially with what we've seen with the memory explosion, and how are the Mark Zuckerbergs of the world actually thinking about that and calculating for that?
Right, exactly. All right, let's talk about CPI and awaiting Kevin Warsh a little bit. So we got Kevin Warsh's testimony. He's set to speak at 10 a.m. Eastern before Congress. And as Michael Reed from RBC told us in the last hour, this CPI report bought them a little time, right? Gave them a little grace in terms of whether the Fed is going to have to raise rates. Looks like they're not, at least if you use the Chris Waller metric. He spoke yesterday and said, if this report is hot, I'm really seriously going to think about raising in July. But if it's not hot, I'm not going to be convinced by this one report. I'm going to need to see more reports. So yes, CPI fell 0.4%. Headline. If you back out one time, the energy and food volatile element, you get a flat reading or very slightly negative, unrounded. So that all seems like good news. But now we just got to wait until next month.
Right. If we look under the hood a little bit, obviously energy really driving the downtick. Energy down 5.7%. Energy commodities, that's your gasoline, your fuels, that's down close to 10% on both of those. But also we're seeing declines elsewhere, as you were pointing out, Julie. We're seeing declines in transportation, though that could be energy linked. We're seeing declines in apparel. We're seeing declines in used cars and trucks. So you see that pulling back a little bit. I think it does buy the Fed time. The question, of course, is going to be, what does next month look like? The market's still pricing in a hike to come this year, now pricing in a hike by October. So does this shift those bets? And really, what does next month's report look like, especially as we see the war picking back up?
To you guys' points, it was an immediate reaction in terms of odds of the July hike. That was pretty interesting to see, but I think it is just kind of somewhat kicking the can down the road because, to your point, there's a couple different elements too. If you strip out food and energy, looking at core, basically flat. And the idea of kind of where oil prices start to trickle into this is, it's kind of like, okay, if we're back into a problem in Iran, what is that going to do to oil prices? And maybe are we talking about this 3 months down the line? And the other element too, Mike Green, who was just on Coinage with me last week, was talking about this also being potentially a head fake where it's not all about oil, it's also about shelter and how that's being baked into CPI. And that being an overlooked element here might be continued bullishness in terms of better numbers moving forward.
Yeah. So shelter, just to give a brief shout out to that, was up 0.1%, which is a deceleration from where we had seen it before. I'm just doing some scrolling here to make sure that I'm reading the right things here. But a deceleration from the prior 2 months is what we saw in those shelter costs. So that's good. The prior 2 months had been 0.3% and 0.6%. So it's been decreasing pretty steadily there. I gotta admit, I love CPI. Like I like PPI too. I love being able to look like on a very granular level. Like most of the time, I have no idea why things are swinging. Like tomatoes, which had seen a big run up because of weather, are now falling back about 10% during the month. So that's good news because we're at the height of tomato season.
That's right.
Here in the New York metropolitan area. So that is good news. Although I will say the farmers markets have been.
They're not getting the memo.
Pretty pricey
not
this
looking
year.
great.
Collusion.
Come on.
Among the farmers.
Let's not get crazy here.
Bust that
private
market
equity's
up.
buying the
We
farmland now.
love our farmers. We don't want to,
We do.
I'm happy to give them my money.
We do.
But yes. So, but I do love looking at all the individual components. I find it fascinating. So here's good news. Lodging away from home down 2.3%. Lodging away from home, other lodging away from home that includes hotels and motels, and maybe that also includes Airbnb, is down 2.8%. So that's maybe good news that we're seeing that. I'm going to search up airfares too to see.
So airline fares
there we go.
up 26.5% still year over year. That's right.
Month over month, are we seeing them decline?
Let me pull
That's the big question that we saw.
0.2% up. So
We talked
still-
about that
still-
last week too in the Delta earnings.
That's right.
From Ed Bastian, basically
right.
saying, look, inflation's hot, but it's not as hot in air travel, so you're going to love flying around. And it is. I mean, there are relative price increases. You feel it. Depending on what you're buying.
Yeah. And to his point, people keep traveling. People keep buying plane tickets. The planes take off from the ground full 99% of the time. People are still spending, even if it is hotter.
Well, and I want to make another point too, which is like, okay, yes, I'll take it that it was down 0.4%. But people are not going to feel better about prices for a long, long time.
That's right.
Because we're still feeling like I don't go to the grocery store and say, oh, I'm spending a little bit less this month than I did, except for something like eggs or gas.
Sure.
Or tomatoes,
Or
apparently.
tomatoes.
tomatoes.
Maybe. But overall, I'm thinking, pre-pandemic I spent this, and now I'm spending this, and it's much higher.
That difference is still stark.
And that psychological, feeling that I and people in general have, you see that show up in confidence numbers too. Like that doesn't dissipate with a few months of disinflation.
Well, I think that's also kind of the tricky spot that Fed Chair Warsh is in now, because you're the new guy on the beat, and essentially you've got people feeling that way. So it almost kind of makes you overcorrect to being extremely strong, at least in your statements, against inflation and taming it.
Yeah.
And the idea of kind of now, as we're talking about this CPI report, it might be one of the more important ones in a long time, because suddenly it has made his job a little bit easier in terms of not needing to come out and sound so dire about the problem and overreacting that, maybe he can be a little bit more, shall we say, even tempered when it comes to his testimony.
His style just
is he even tempered?
It kind of cracks me up, right? The end of his statement: "We are the Federal Reserve, and we are as determined as ever to fulfill the mission that Congress has given us." Like this guy, even if he's not cutting rates, this is Trump's guy. Like who else?
That's right.
Like Jay Powell would never.
No.
We are the Federal Reserve, and we are here to fulfill our. It's like. He's Superman flying to the rescue. Like that's
the war on inflation. It's the war on
That's
prices.
right.
The war on
That's
inflation.
right. The war on inflation.
We can fix it. It's so fascinating to me that tone and that vibe. I mean, listen, he's not going to read it like that. I mean, he plays
more even keel, But if you read the words, they do sound more.
I mean, look, the members of our committee have no tolerance for persistently elevated inflation. That's pretty firm language.
Yeah, it is.
Now, looking ahead to the week, to your point, Julie, about how people are going to feel about this, we're going to get the preliminary reading from the University of Michigan for July. Economists expecting those numbers to actually look a little healthier than the last reading.
We'll see.
At the same time, though, to your point, people know what things cost. You go to the grocery store, even if you don't know what the item exactly might be, you know what the bill is for the set of groceries you buy every week. And if that's not feeling really better, meaningfully better it's going to be a tough argument to make that, oh, everything's under control, the economy's doing great,
Right.
we've got inflation under control, and it's coming down.
Yeah. All right. We got to pause on all this, and we got to talk about the last thing, which I know you want to talk about, which is oil. So Jake and I keep talking about oil in the newsroom, Zach. And just yesterday, he said, I and everyone else who covers oil, either as a journalist or an analyst, we all feel like we're going crazy because oil prices should be so much higher than they are. If you use any kind of the traditional metrics or any, logic,
Just history.
they are higher today.
Sure.
But what? So what is it feels like the oil industry is the boy who cried wolf. Like,
That's
oh,
right.
we're gonna 100, 250, it's gonna be crazy, and it just never really happened.
That's right. Well, I think there are two things going on here. And to your point, every single oil trader I talk to, who I'm talking to every single day, keep making that point. We feel insane because prices feel like they should be so much higher. There's two things I think going on here. The first is that this was unmodelable. If you had asked an analyst in January or last year what oil would do if the Strait of Hormuz was legitimately closed, I think they might have sold you, oh, oil's going to $500.
Yeah.
Because this is in the 1,000 years that waterway has been operated for trade, it had never shut. This is the biggest supply disruption in history. It is unmodelable. That's one problem. The second problem, and this is the reason why oil didn't go to 200 the first time, we came into this war running a 3 million barrel a day surplus globally. That gave us a lot of room. That was drawn down. Also, China, the world's biggest importer, the swing buyer for the market, really stopped buying. Mm-hmm. Three things are now true, however. The war is restarting, and it looks like traffic through the Strait of Hormuz is careening. We don't have those surpluses anymore. Those are gone. We have drawn those down. And China is starting to buy again. We see the refineries picking up their purchases. Again, I don't want to do the boy who cried wolf dance, but every single trader I talk to says to me, all three of these things tell me there is only one way oil can go, and it has to go up. It doesn't.
That was
but it
true.
has to.
Just to play the other side, I think
Please.
The Strategic Petroleum Reserve is very interesting because a lot of people say Trump had tapped that down way too early, but it was also President Biden who had done that before.
That's right.
And now, we saw this back when I was here too. The weird thing in the pandemic when oil flipped negative for a little bit, and everyone's like, "What's going on there?"
It was a bizarre day.
The contracts. It's a very weird thing to do apples to apples comparisons because so many things are shifting underneath.
Right.
And I think the idea of where we are here versus the beginning of the war is there was enough time for a lot of the supply issues to kind of start to get figured out and figure out where you're going to draw from. But I think, again, we've heard this from analysts, or at least I have, in terms of where we go from here is very different than where we were before.
That's right.
And how we kind of start to figure out where some of the supply gaps get filled, I think if this lasts this time around, months, you're okay. If it is the case that Trump is fully committed to kind of letting this drag on, then you're eventually going to see it. And we kind of saw the same thing when this war started, if you remember kind of how long it took for some of those prices to eventually hit the areas where we all knew they were going to go. I don't know. It's always a constant thing of how prepared is the market and how long do they actually think this is going to drag on. I get the sense that based on where we are, some people think that Trump will still figure it out and close the situation before November.
Part of the deal. Now, in fairness, the industry is looking for alternatives.
Right.
U.S. producers have started boosting their numbers, putting more and more money toward exploration.
Pipelines being
We've seen
built in the
pipelines getting
Mideast.
built, but you can't compensate overnight or even
No, it'll
over a
take time.
year for a 15 million barrel a day loss.
All right, we got to leave it there, guys.
You got oil nerds around Yahoo now.
He's
Oil
like a
nerds.
major oil nerd.
I am a major oil nerd, that's
self-described.
right.
All right, Zach, thanks so
Good to
much.
see
Dave,
you.
thanks a lot.
Thank you.
Opening bid is next.
I have a little bit of everything for you today, friends. I want to start with something that the market didn't expect coming into today's session. That is a major, brutal, ugly, disturbing pre-earnings warning from tech giant IBM. The warning is so bad, CEO Arvind Krishna opted to write a letter to describe why the quarter badly whiffed. I'll sum up what he said this way. More businesses appear to be spending on AI-related CapEx, such as servers and storage, let's say from the likes of Dell, than what IBM is selling in mainframes. Unfortunately for IBM, this is happening so quickly that its forecasting prowess needs to improve fast. Ultimately, this is bad news for IBM and perhaps many in the tech ecosystem. More on all this in just a moment with my opening bid roundtable. I know they want to weigh in on this. On the more positive side, we have the banks out here crushing it on their earnings days, which the market expected, as many of the top banks had stock prices near records headed into the earnings prints. Goldman Sachs, JP Morgan, Bank of America, and Citigroup all had strong quarters in trading, with markets near records, and investment banking with more IPOs happening, all strong quarters in the IPO space for these banks. All of these banks also called out solid U.S. economic trends too. I did find this funny though, this call out of JP Morgan CEO Jamie Dimon. I asked him if an interest rate hike from the Fed would cause some of the risks he laid out in the earnings release to collide. He laughed briefly and said, quote, "I wish I knew the answer to that question. We don't know. We're just isolating that there are issues out there. They're pretty important and substantial. You know, they can easily go away. They can easily collide in a way that will surprise you. And it won't just be the Fed and inflation. It might be a whole bunch of the geopolitical stuff. So just something to keep an eye on. Of course, we're always preparing for various types of risks. That is, of course, a old school line by Jamie Dimon. I can't believe he laughed at me. Here in the opening bid roundtable, Thomas Martin, Global Investments Senior Portfolio Manager, Tom Essay, Simmons Report Research Founder, alongside Yahoo Finance's own Brooke DePalma. Good to see you all. Tom Essay, I'm starting with you. Let's push aside those bank results for a second. Like I mentioned at the top, we knew they were coming. How disturbing is this IBM warning?
Good morning, Brian. It's pretty disturbing, at least in the short term. So it's really a bad blow for software at a time when they were just kind of starting to pick their head up. And here's sort of the rationale. People are concerned that over the long term, AI is going to disrupt software and other parts of tech. But in the short term, a profit should have been fine, right? Well, now IBM comes along and says, well, it turns out all of our customers are so scared about not having the compute and server and cloud storage capacity they need for the AI rollout that they're actually redirecting their budgets towards that and buying like crazy. And now it's hurting us in the near term. This is a pretty surprising negative. I don't think a lot of people saw it to this intensity, and I think it is a pretty material negative for software. It's not a good look this morning.
Well, Thomas, on the positive side, this stock decline might cause IBM's dividend yield to go up. But I imagine on a day like this, nobody gives a crap about any of that. How bad, what's the read-through, like Tom mentioned, Thomas, what is the read-through to software more broadly if, we're seeing IBM call out people saying they don't want to buy these expensive mainframes, they'd rather invest money in storage and servers?
Right. Well, so just on the positive side, we also have the chips and the semiconductors, which have been getting hit and basically going up and down depending on the day. And this is being driven by the data center trade. And what IBM is saying is that trade is still very much alive for the equipment that goes into it. So bad for software, but probably good at the margin for the makers of the equipment that goes into those data centers.
If you're on the Yahoo Finance platform right now or in Yahoo Finance Alpha Space, I think over the next week you really have to start tracking analyst earnings estimates, not only for an IBM because they're going to come way down literally by the end of today, but for many other software players. Because when an IBM warns like this, and you see the stock really poised to have its worst day since 1961, now it's down 25% here. This is absolutely brutal, Brooke. Really, really brutal.
Really brutal indeed. And I think what's so interesting is that we're getting a direct read through within this letter that the CEO put out to investors on an exact timeline of when exactly this is all playing out. He said specifically that in the last few weeks of June is that when they saw clients shift their quarterly CapEx spend towards servers, storage, and memory purchases to secure supply-constrained infrastructure ahead of these expected price increases. Now, what we're hearing from so many different sources is that they expect this memory storage concerns to last, some even saying into 2028. And so what exactly does this mean looking forward for IBM? That's definitely the big concern here. They even noted that they did not adapt and move quickly enough. I think it's a big question mark right now of how exactly IBM plans to adapt and what their next move is.
Tom Essay, I'm going to run out of time here. There's so many different thoughts I have on this. One being that this report or this warning from IBM already signals perhaps CapEx increased guidance when some of these hyperscalers report. Now, they just raised their estimates on how much they plan to spend 3 months ago. The market hated it, but I'm already expecting that more out of them. Do you think, Tom Essay, though, that the SaaSpocalypse trade is back on here after this IBM news?
I think it'll be on for a couple of weeks until we hear from somebody else. I think that you were just seeing software stick its head up and try and show some signs of life at the expense of some of the services, Thomas said. This is going to totally reverse that. However, to me, this just also reinforces that it is like all in on the component demand right now. We are in the midst of a buying mania of AI data center components by the richest companies in the world. And all I can think is, boy, this better work. Because if it doesn't, they are going to have spent so much money buying all these components that in the end they don't need, that the future could be bumpy. But for now, I think, yes, I think software is going to take a hit. I think IGV is in trouble, and I think it'll last a little while.
Tom, my brain can't handle any more now, thoughts. I'm just trying to process everything I'm reading now, but all this stuff better work out. Thomas, is IBM just dead money here now going forward?
I think that this is one that you're going to have to wait, and it's going to be in the penalty box for a while as they adjust their business. The software issue is, there's certain kinds of software that are going to be just very, very important to AI, but the corporate kinds of things that can be easily replicated or more easily replicated by AI, those are going to be the tough ones. So it's going to get hit all at once as a monolith, but ultimately there's differences in the types of software that are going to work in this environment, and that hopefully will be recognized over coming quarters.
Brooke, I'm going to contain myself and just put this IBM news aside. I can literally talk about this for 8 hours straight, if not 12. But Brooke, I saw you go live on social media off of those CPI results. At first blush, it was good to see prices down. I think the market liked it. But then right after that, we got a release of Kevin Warsh, new Fed chair, some of his comments, and he sounded like, you know what? I'm going to be an inflation fighter. President may not like it, but I'm here to fight inflation.
Yeah, and I think we're still way off from that 2% target that the Fed's coming from, even if this CPI print did come in slightly lower, or rather an increase that was lower than what I expected. We also saw the first monthly decrease since about 2020. And so reading through some of the rhetoric there, I mean, this is what we've been trying to get towards. But I think the fact that this is a look back is very signified here, if that's even a word to say.
It is a word.
I mean,
whatever you say, Brooke, it's a word. I'm going with it.
When you think about the fact that, this obviously is a look back. Yesterday, we saw the highest jump in international Brent that we've seen since 2020. I mean, how much significance does this report hold? I think that's a big question mark, especially ahead of Kevin Warsh, what we'll hear from him today.
Tom, I thought Kevin Warsh was going to be a dove. I thought he was going to give the president what he wanted. Now we have him out here talking about potential Fed rate hikes.
Well, he has to talk.
It's definitely.
Go ahead, Tom Essay.
It's definitely been a surprise. He has definitely come out more hawkish than I think people had thought in his tone. But, we also have to focus on what the Fed does. And if we cut through kind of the very short statement and some of his commentary, the Fed really did in June exactly what we thought they were going to do, and they're most likely going to do in July what we think they're going to do, which is nothing, right? So certainly I think that he is trying to use a little bit of a hawkish tone to help the market do some work for him on rates and to pressure inflation. But while the CPI print was positive, the market's always, what have you done for me lately, right? And so now we're looking at oil higher. And even if inflation peaked in June or in May, which it probably did for the year, it still has to decline further to take rate hikes off the table for later in 2026. We've got to see some more continuation of these numbers in the coming months.
Thomas, I am of the view that I think we're going to get a rate hike this year. I'm not ruling out two. I mean, we can save this tape and we can look back at the end of the year, whatever it is. If one does expect rate hikes into year end, what sectors do you think will work and why?
This Thomas?
That's Thomas. Yes.
Having two of them on the show. I think that it's going to be good for banks and for the financial community, notwithstanding the initial reaction today. At the margin, it's going to make it more difficult for those companies that are going after capital, although for the AI and data center trade, they have plenty of money and a willingness to spend and can tolerate those rates. So I think as long as the 10-year can stay in the 4.5 to 4.6 area, it'll sort of be business as usual and people will just sort of adjust.
Brooke, maybe if the Fed hikes rates, we can bring those egg prices down because then the index rise in that report.
Yeah, I mean, what we did see was egg prices once again fall yet again for another straight month. We also did see butter prices soften. So some
softening butter prices. Brooke with the pun.
Exactly.
I love it.
Exactly. You got to point that out as well. But that's some staples within Americans' refrigerators. You also did see tomato prices increase yet again, coffee prices increase yet again, as well as those uncooked ground beef prices now sitting at $6.98. From what I'm seeing, a quick read through, I mean, that's the highest that we've seen, I think almost ever. And so this just goes to show that these key consumer staples are still under pressure, and we're continuing to see the price of groceries go up. Of course, how much the Fed will read into that is yet to be determined, especially as they strip out these volatile categories.
Tom Essay, it ain't cheap to have a backyard barbecue this summer. Make no mistake about it. I mean, these prices have gone through the roof, especially for beef. Look, I like what a lot of these big banks said this morning about consumer resiliency. How long could this continue? Bank of America called it out. JP Morgan called it out. I think even Citigroup called it out too.
as long as the unemployment rate stays low. That's the key to the whole sort of economic resiliency. That and the fact that the hyperscalers are just fire hosing hundreds of billions of dollars into all corners of the economy as they build out data centers as fast as they can. But the unemployment rate is low and people can get jobs. And as long as that's the case, then they're going to be generally able to keep up, relatively speaking, with this inflation. And that's been the key. The trouble is if that unemployment rate starts to rise or that people start to have a hard time finding jobs. That's the linchpin. As long as the unemployment stays low, then people can continue to stomach very high beef prices and egg prices and all the other things we're having to deal with.
Brooke, I'm surprised about butter price. I think butter is having a renewed moment, though, in diets.
I mean, if you say so, Brian, I mean, if you think about years ago, I don't know if you remember that butter board trend, but that certainly drove prices higher. But you know, butter is declining. I also do want to point out that what we're seeing as far as egg prices go, another staple, is actually the lowest prices that we've seen since November of 2023. And so it's interesting to see how this sort of have played out. We got off that flu outbreak that hit the flocks, and now we're sort of recovering from there. But I think that the big question mark here is when ranchers will ultimately finally recover from that drought that we saw years ago that impacted the supply here in the U.S. And that story still holds on. But butter is certainly a welcoming surprise, I guess you could say. I guess, Brian, you're a big baker, and that's a...
No, I just take my butter, I put it on my beef, Brooke. I can't do this right now. Thomas Brooks, stick with me. More coming up. My stock of the day is not butter related. Definitely not, even though I wish it was. It's Netflix. More on this next. Battered Netflix investors may end up tuning in to another dose of bad news when the company reports earnings on July 16th. No new hits, unfavorable currency movements, huge amounts of money being spent on original content. All of this is a recipe for another earnings day downer. In fact, Netflix shares are trading as if another guidance letdown is already in the cards. The stock is down 11% in the past month, bringing its year-to-date slide to 22%. Shares have plunged 41% over the past year. Still with me, Thomas Martin, Tom Essay, Double Tom, and Brooke DePalma. Only one of Brooke here on our set today. Thomas, let me start with you here. I think we all have an idea on what has been plaguing Netflix. I mean, they haven't had a lot of hits lately. They didn't get the Warner Brothers deal done. Would you be a buyer here into the earnings report?
Right. So we think that Netflix is really a show me stock in here for the reasons that you've mentioned. And this earnings report will make somewhat of a difference. But what really has to be worked out is a couple of things. One is the slate for the second half. There aren't any real blockbusters, but they are bringing back some shows that should get some good viewership and engagement, second and third seasons, et cetera. We'll have to see how that pans out. But the advertising is another issue where they're gaining some traction there, and they have to have those tiers, but it really isn't the most efficient as far as them making money. So how the customer finally adjusts to ads versus the higher tiers where they don't have to see ads is another issue. You'll have to just see how those work out in the coming quarters.
Tom Essay, if I'm one to be so jazzed about getting involved in the media space from an investment standpoint, why not just kick the tires on Disney? They're probably having a bang-up summer at the parks, as we've heard from the banks today. I mean, the consumer is still resilient, so the parks are probably doing good. Disney's pushing through higher price increases. Consumers are still out there spending. And then, they're also involved with sports in a major way.
Yeah, I actually agree with you. And they have, potentially a successful reboot of the Marvel franchise coming later on this year with the Avengers and Spider-Man. So I actually think it's a more compelling case than Netflix. Over the past couple of years, Netflix has pulled levers to increase profitability by cracking down on sharing, by introducing, more aggressive advertising, that sort of thing. But in the end, they're now kind of being driven by their show slate. And as you said, they have not had a hit in a while, and that's a problem. Now, certainly the decline makes it, somewhat attractive, maybe on a value basis. But I agree with Thomas. It's a show me stock. You have to see that there's some sort of a turnaround or something coming down the pike that you can get excited about. I actually agree with you, Brian. I think if I'm going to allocate some dollars to entertainment and sort of, content, I would prefer Disney.
Or Tom, what about even Alphabet? When, let's say Netflix comes out here and the quarter's not great, which I'm expecting to actually happen. And this is another big boost for YouTube. YouTube has been an absolute juggernaut, and it's only getting stronger.
Absolutely. It's YouTube is sort of really hitting on all cylinders, and you get a whole bunch of extra stuff with Alphabet as well, right, related to AI, and they're obviously their core business. So I think that's part of the problem for Netflix, is that you look around this sector, and without a compelling hit, there's other alternatives for capital where you get some add-ons in addition to the content business.
Brooke, I don't like how Netflix recently changed their home screen. It's upsetting me, Brooke.
Well, I didn't even notice that. So that goes to show maybe how much I'm on Netflix compared to you, Brian. But what I will say is that it's interesting to see how exactly this will play out in terms of their price increases. They did implement those back in March. And I know for myself, I don't personally have that ad tier, but it seems like that's where most of the viewers are going right now. And they're not necessarily changing to that more premium tier where they won't get the ads. So it'll be interesting to see how this plays out, how the rollout of those higher prices go, whether or not there was a lower or higher than expected churn of people maybe, taking a lower ad tier or maybe even entirely canceling and going to something like a Paramount Plus or like a Disney Plus instead.
All right, we're going to stay on tech here. Meta stock is finally shaking off a long stay in the penalty box, at least until the company reports earnings in a few weeks and serves up an eye-popping number for AI-related CapEx spending. The stock has now closed above its 200-day moving average for 2 consecutive days, its lowest stretch since February, according to Yahoo Finance AlphaSpace data. Love AlphaSpace. Meta shares have traded up 23% from their late June lows versus a 3% advance for the S&P 500. Microsoft shares have also traded up off the June lows. My question is this: after a long slumber this year, are investors returning to the Mag 7 names? And if so, is it the right move? Tom Messi, coming to you because I know you watch a lot of charts. Am I just reading too much into this meta move?
No, I don't think you are. I mean, I think that the chart has certainly improved. I think that why is what matters, right? So essentially, kind of the bullish catalyst was AI deciding to lease out a lot of their processing power and compute to all this AI demand. So here we go. We're sort of leveraging on the AI data center demand craziness even more. And don't get me wrong, people are paying for a premium, and I think that this is a very smart move by Meta. But I don't view this as sort of this isn't a sustainable turn for them. This is them just looking around saying, okay, what can we make money on? And we have capacity here, and let's lease it out while demand is sky high. Shrewd move in the short term. I think it is created a decent size bump in the stock, obviously, and the chart is looking better. But for me, it's going to be about earnings. It's going to be about their CapEx number, what's happening with free cash flow, and what is their guidance on how we turn all of this into real money sooner than later.
Thomas, are you have any interest in playing these Mag 7 names on the pullback? And I hope I have my notes correct. You like Palantir here. Why?
Oh, right. So not a Mag 7 name. And the Mag 7 are not really monolithic the way they used to be. So you have to really evaluate each of those companies separately for the fundamentals that they have. But with regard to Palantir, one of the reasons I like that, as I mentioned earlier, that the software providers that can actually make AI work and work in complex situations where they are using the large language models or their large language model agnostic. That's what Palantir is they're working in the complex areas. They're working at the operational level at helping companies to solve significant problems, to secure their data, to have compliance and governance, which are still at just new stages of AI adoption. So the stock is down a good bit from here, probably taking a hit with the rest of software, but they have a business that is going to be an AI survivor in our view.
Brooke, going back to Meta, I still don't think investors fully understand how aggressive Mark Zuckerberg plans to be with AI CapEx over at Meta. Now, they have voiced their displeasure with this by setting the stock lower from the last earnings report really into the end of June. But Zuckerberg is all in. And you just look at that Reality Labs business, he has shown a propensity to just stay all in, even if it means losing large sums of money and pissing off investors.
Well, I think this certainly does show that Mark Zuckerberg is very serious about this AI build out. And I also think it's interesting to see the way in which Meta is has taken a play page out of what Amazon's doing in terms of renting out that excess compute capacity. And I think that Mark Zuckerberg is willing to go to the X extent in order to make this fundamentally work, but also encourage investors that this is going to work. I mean, I can't help but think about the hype around the Metasphere and all that hype that he had and the willingness he was to be able to fully commit. Of course, that didn't work out here. Of course, he's much hoping for a different story.
Indeed he is. All right. Thank you, Double Toms and Brooke. We appreciate it. Good to see you all. Awesome analysis. It was a very big morning for news. All right, coming up, we'll be taking Fed Chairman Kevin Warsh's congressional testimony live. Keep an eye on what Warsh has to say about today's inflation report. It's very likely to be a market mover.
Welcome to Market Catalyst. I'm Julie Hyman. We are awaiting testimony from Kevin Warsh. He's making his first testimony before Congress as Federal Reserve Chair. And markets, of course, are also digesting the latest inflation data, with the Consumer Price Index coming in at 3.5% year over year. That is more mild, better than had been anticipated. Wall Street's big banks also kicked off earnings season, posting strong results. There's a lot to talk about, in other words, between all of this going on. As we await that testimony beginning from Kevin Warsh, I'm joined by our Brooke DePalma and Jared Blickery. And guys, we have the testimony, the beginning testimony. So the way it works is he testifies before Congress. He has an opening statement that gets released to the press. So we do have that in hand. And then, of course, the fireworks begin once they begin questioning him. Mm-hmm. Right. But, I think the theme, one of the themes from his testimony as it's released is like, we are ready to slay inflation.
Yeah.
Although the CPI report this morning showed maybe there's not that much inflation to slay. At least, we have to see what the future months will show.
Right.
But he got a little breathing room this morning. Mm-hmm.
That's exactly what I would call it, a little bit of breathing room. I was looking at Fed rate hike odds, and they didn't move quite as much as I would have thought they would, given the fact that Wall Street expectations were for a much hotter report. I mean, what was it, core inflation that came out break even here? 0%, which was a nice surprise. But nevertheless, a tiny bit of a reprieve. We saw long-term yields like the 30-year, which was well above 5%, kind of declined toward 5%. So that was a nice thing to see. The stocks are down right now, so it's not the greatest reaction, but there's a lot of other stuff going on. And I think there's the whole communication issue
as well. Stocks are up, actually.
Oh, stocks are up?
We're having some data
okay.
issues, so stocks are up a little bit, not a
led by the
gain.
Nasdaq, up about 0.5% though, still. S&P 500 up 0.25%, and the Dow moving higher, even though in pre-market trading, we did see IBM weighing on that report, weighing on that index rather. To Jared's point, though, I think what is interesting is that right now, based upon that FedWatch tool from the CME Group, what we are seeing is a rate hike in the month of September. And that's right now the only rate hike that the market is pricing in. I think that's an interesting narrative. I mean, heading into this year, we were expecting rate cuts. And now that we're expecting a few rate hikes, some even saying 3 rate hikes on the table potentially. And now that the markets are only pricing in 1 rate hike, just goes to show, is this transitory? Everything that's happening right now with the conflict with Iran, how will higher crude oil prices and higher, Brent prices, oil prices overall weigh into future reports, and how long will this moment in time last as oil prices have surged over the past 2 days?
Yeah, we were talking to Michael Reed of RBC this morning.
No rate hikes, no rate hikes, no rate cuts, no moves.
I mean, that seems to be an increasing number of people on the street perhaps are saying that we're not going to see a move. But he said it's really hard to suss out, because we saw, yes, obviously a decline in energy prices show up in the CPI report, but we also saw declines in things like apparel, the prices of apparel. So he said it's difficult, even for an economist, to suss out, okay, what is the direct line from energy prices to the cost of X, and how quickly does it change? Yeah. So it's difficult to suss out the relationship between oil prices and all these underlying prices. And
guess what? WTI is back up at $80 a barrel.
Exactly.
And it could easily go to 85 and mean nothing in terms of the price. Now, it would mean something in the price that we pay at the pump. It would mean something at those other prices. But technically, it could easily just bounce between $85 to the upside and maybe even as low as the high 50s on the downside, and just not really mean a whole lot there. My big takeaway from the inflation report this morning, I think it's a reprieve report, but it still shows a lot of underlying inflation. And for the average person, they're still feeling a lot of this.
Yes.
You take a look at transportation prices, airline prices for seats are up about 20-25%. There's just a lot here that doesn't give necessarily consumers a reprieve, but it gives the Fed officials who have to react to this report a reprieve. One of the things I do appreciate about Warsh is he's not as vocal on these matters, and he doesn't want to be as other Fed officials have been in the recent past. And I think, you go back to the global financial crisis, a lot of people didn't know what the Fed was back then, but a lot of people got angry with the Fed in the coming years and with the lack of accountability at the highest levels of finance. And so I think the Fed kind of went a little bit too far on the on the talkative front.
Yes.
And people started measuring, they were looking at reports like CPI and the payrolls report and saying, okay, what's the Fed going to think about this? That became more important than the actual data, and that's where we are now. I see Warsh is kind of trying to dial that back a little bit.
It's going to be tough.
Yeah, because that's what we're used to.
It's going to be very tough. The markets are conditioned to make that,
for a decade and a half.
And to hear from, say, Jerome Powell right after the Fed minutes break, and to hear that press conference, I think a lot of the markets are relying on that. I do want to point out one thing, though. We continue to hear from Warsh, and that are the words price stability. I'm like, let me get that right. It's price stability. I mean, within these opening remarks today, he said specifically, the members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability. I mean, this is something that we hear over and over from Kevin Warsh, is his commitment to make sure that prices remain stable, that the consumer isn't out of Wonka. Isn't that
and where does that term come from? Price stability comes from the Federal Reserve Act. The Federal Reserve Act doesn't say, okay, inflation needs to be 2%, and that's what the Fed needs to watch. It says prices need to be stable, and it also says employment needs to be at a maximum. It also says long-term interest rates need to be moderate. So there are three things in there, but that's a discussion for another day. Price stability, that phrasing comes from the Federal Reserve Act. The Federal Reserve only interprets that to mean 2% inflation, but that could change. And we've seen over the last few years people saying, well, maybe the Fed should make that 3%. Kevin Warsh has said, before we just arbitrarily change it, we should actually prove that we can target it. So I don't think that's an option for him. One quick quote, he said this the other day, sternly staring at inflation until it melts before our withering gaze is not an option. So, that's just kind of the navel gazing view is not an option for him. He wants to see actual commitments and see things go in the right direction before he acts.
And so he's going to have a bunch of task forces for that.
There's a shadow Fed now. How about that?
Including
Mark Andreessen is on it.
Walmart CEO Doug McMillon going to be on one of those task forces.
Yeah, a lot of task forces. We'll see what they actually come up with at the end of the day.
I've got theories on that. How much time we got?
Julie's not. You're not optimistic about the task force idea.
I'm fine about the task forces. I think it is really difficult to change institutions. I applaud him for trying. I think it's the right thing to do. I do think it needed reform. And task forces is as good a way to do it as any. But, as we saw with things like Doge, if you come into a government institution, now Doge the remit was much larger.
Yeah, that was its own animal.
But exactly.
It was its own animal.
Brought in a lot more voices and
yes, but to what end? Ultimately, I don't know. I applaud him for doing it. I am waiting for the results.
Yeah, if you take a look at the economic, not the economic landscape, but the landscape of economists around in the United States and the world, there's a huge influence by the Federal Reserve, and you can take that for better or for worse. But it's hard to get a lot of times opinions from economists who are not aligned with the Fed in some way, who haven't worked for the Fed, who haven't received grants for them. And I think that's what he's going after. I think he wants a more diversified opinion. So he's got Mark Andreessen on there. He's got people who have led companies like Walmart. So that gets back to that comment. So, it's a lot to change an institution, but it's something that I would like to see as well.
By the way, in the background today of all of this going on, not so much in the background, we got bank earnings, right?
Yeah.
Oh, yeah.
Lots of banks earnings.
Yeah, lots of bank earnings, and they are not all trading higher, even though many of them did pretty well. I mean, I still keep being amazed by the equities trading revenue.
It was up 86% at JP Morgan, up something 72.4% at Goldman Sachs.
Yes, and even at Wells and Citigroup, it was up 45% each. So
these big banks make a lot of money when the markets are kind of in turmoil. So what do we see? The Iran war headlines generated a lot of volatility. We saw the VIX shooting up. That's when proprietary trading desks at these big banks are at their best, because there's a lot of arbitrage opportunities. When there's chaos, then the institutional traders, especially the short-term ones, can make a lot of money there.
Also, JP Morgan pointing out the impact that SpaceX IPO had on the company as well. They said specifically they saw particularly strong performance in equity underwriting fees. Of course, SpaceX being
and of course they're not the only ones, right? Because everybody was involved.
Morgan Stanley, Goldman Sachs,
and there's an uptick in M&A activity. So as we talked about on the earlier show on Morning Brief, the question then becomes, okay, can you repeat that equities trading revenue? Is the cadence of M&A and IPOs going to hold up? And so some of these stocks that you would think maybe would be trading higher are not trading higher this morning in part because of that.
I think the big question is, like, are these stocks already priced for perfection?
Financial, some of these financial stocks have been hitting record highs, to your point. I don't think that, but it's kind of been a stealth move. I haven't been hearing analysts on our show say there's too much money chasing financials right now. The money has been the hot money. The thirsty cash has been has been chasing those chip names, software names a little bit, not the financials name. Nevertheless, the financials have been one of the top performing sectors this month, and we're only about halfway through July, but I have seen them kind of assert recently, so they are on my radar.
And if I'm seeing it right, Goldman Sachs right now up about 7% as we make our way to today. JP Morgan
Goldman Sachs
down,
keeps
flat.
extending its gains. Also, JP Morgan came out and talked about increased costs this year. So that's something else that
Goldman Sachs almost at a record high, if not at one right now.
All right, we'll keep watching that. Guys, I want to put you on pause. Again, we're waiting for Kevin Warsh's testimony, but there's another stock that we have to talk about today that is the worst performer on the day. It might even be having its worst day ever, at least as far back as our data goes. I'm talking about IBM. Those shares are down more than 20%. The company unexpectedly pre-reporting earnings, and it issued a warning for the second quarter. The CEO, Arvind Krishna, blaming weakness in software and infrastructures. Consumers are shifting to memory purchases to secure supply-constrained hardware. Our Dan Halley has been following all of this. And Dan, again, this was a surprise. The company is set to report next week, so we should get more of a fuller picture around what happened exactly in the quarter.
Yeah, obviously they fell short here. I guess that's kind of an understatement given the market's reaction, down 24% last I looked. And, if we could just go over the numbers really quick. I mean, they saw adjusted earnings per share of $2.93. The street was looking for $3.02. Revenue came in at $17.2 billion. The street was looking for $17.86 billion. So obviously coming up well short there. Arvind Krishna basically saying that, look, we had a great period when it came to the launch of our Z17 mainframe system, but the fall off from that was a lot worse than anticipated. And so that obviously impacted the bottom line. And then obviously the big point out here that he makes is that customers had been moving from purchasing software and infrastructure like mainframes to servers, AI memory, and AI storage, and basically saying that they are trying to get into that space, purchase what they can just ahead of anticipated price increases as a result of this global shortage that we continue to see. So basically what happened was customers said, okay, we'll put a hold on spending at IBM. We'll go over to these memory companies, buy what we can there so that we can get any kind of deal possible right now, and then we'll look at IBM later, and that seems to be the biggest hit here. They also mentioned the rapidly changing environment with regards to cybersecurity. We've seen obviously Anthropic come out with their Mythos 5 model. That really kind of roiled that space. People kind of thinking, well, now everything's up in the air when it comes to cybersecurity. This particular model apparently very good at finding flaws and exploiting those flaws in software, although they did set up their own kind of initiative called Lightwell to address that. We're just not sure when that'll actually start to show up for IBM's bottom line.
Well, and it's interesting to see what other software companies are doing this morning. I'm looking at Salesforce, for example, that's down about 3%. Some of the cybersecurity names on the flip side are higher. So obviously the market is trying to figure out, okay, is this an IBM situation, or is this something that we are going to hear about from other companies that have these clients that are shifting their spending around?
Yeah, I think the software space has struggled. I guess to put it lightly, as of late. The whole kind of thesis has been, well, AI is just going to kind of demolish it. That's, analysts have kind of said maybe, maybe not. A lot have said that it'll just be integrated into the software. Others have said, look, you're not going to take a Fortune 500 company and then vibe code a CRM for them. You're probably going to stick with a CRM company, and Salesforce likely being one of them, or Microsoft, and then use whatever integrated software there is there. But yeah, I mean, looking at more widely, you have to see what the rest, I think, of the tech industry is going to do when it comes to this quarter. And obviously, if companies are going to be spending more on AI memory and AI storage, there's not going to be a whole heck of a lot of capex left for them to make investments elsewhere. It also remains to be seen how long this will all last. There's been various estimates that this shortage could go through 2027. That's next year. That's not too terrible. Into the next decade, that's a little bit worse. And so we're kind of still trying to figure out where all of this leads and when it starts to kind of peter out.
Yeah, right now the stock is still down very sharply as a result of this. IBM is, and seeing that bleed over. Jared, you've been watching IBM also.
Yes.
You were the one I got that stat from, that it could be its worst drop on record, but we'll see where it ends the day.
Yeah, definitely. In fact, the worst day until coming into this, at least since 1968, was Black Monday 1987.
Oh, wow.
So that's a long time ago. I think this is kind of the first big example, and the market's going to have to deal with this. So it has implications beyond IBM of what enterprise spending is up against. So there are a bunch of mainframe deals that got kind of postponed here late in the quarter. IBM is saying they didn't react fast enough. Enterprises are redirecting their spending from some of these bigger deals that they were working on toward critical things they need. They're spending more money on memory because those prices are up. So IBM is kind of the poster child right now, at least today, for this tug of war that's going on inside corporate America. Is their spending going to be for projects that they already had coming down the pike, or are they going to be forced to allocate significant budgets toward memory and things that they didn't really want to? Nobody wants to spend a lot more money on memory, and it exemplifies this tension that we have between the hyperscalers and the chip makers. Chip makers are really benefiting. Micron had 86% gross margins. That's out of sight when they reported last quarter, but the hyperscalers are funding that right now. Yes. And so there's a rubber meets the road point in here where everything converges. I don't know that we found the equilibrium just yet.
It doesn't feel like it.
No.
And Dan, to take it back to you on the hyperscaler front, I know you're also following Meta, which there's been some reporting that they're expanding their data center in Louisiana, and I think that the number is now 33 of data centers either have been constructed or in construction, in active development, I guess is the way you would put it, for Meta. But this is the biggest one, if I'm not mistaken.
Yeah, this is their massive kind of gargantuan data center that they're building in Louisiana. They do have, or they said they have a global fleet, or are working on a global fleet of 33 data centers. This one will now expand, roughly double the gigawatt capacity, as well as obviously the AI capabilities of the Louisiana space. This is seemingly part of their effort to ensure that they can build their own AI software and service their own AI software. But we've also heard a lot about Meta potentially entering into the cloud space, serving as kind of a neo cloud or kind of hosting various AI models and then offering those up to customers. Now, this would align with that. Zuckerberg spoke to Bloomberg last week, Mark Zuckerberg, CEO of Meta, saying that, yeah, we're looking at that. He's also alluded to it on different earnings calls, not even alluding to it, just saying straight up, it's something that we'll look at if we feel as though we've overbuilt. There's no sense of which direction they're going to go in, whether that's just offering up the raw hardware that companies can then just rent out and do their own processing on, or hosting the AI models. But this appears to be in line with what they would need. If you imagine they're building out their models, they are serving up their own models. They had plans in place already. They're continuing to build data centers, but this is a massive, massive increase in AI processing power. And so you would think, okay, well, this kind of leans into that direction. It also means, though, that they would be going up against the likes of, neo clouds, as I said, CoreWeave. And then if they do end up hosting rival AI models, well, then that's right up there with AWS. I think one of the questions then becomes, okay, who's their customer, right? Some of the biggest companies in the world right now, those AWS's, Google's, Microsoft's, well, they're spoken for. They don't necessarily need to go to Meta and say, hey, can we get some of your processing power? We've seen Google obviously rent out space from SpaceX. Anthropic has worked with Amazon as well as Google. And so, perhaps those are some of the customers that we could see. But, right now I think we're kind of in a wait and see pattern to determine where exactly Meta is going to kind of get that customer base.
It's been pretty fascinating too, Dan, whether you're talking about Meta or whether you're talking about SpaceX, renting out Colossus capacity, that these companies have not been punished for not using all of their own capacity, for renting it out instead, right? Like you would think that SpaceX not needing all of that for Grok would be like a knock on Grok, but like instead, shareholders seem to be happy that they're just getting these other revenue streams.
Yeah, I mean, this is something that may come back to, bite them later. When SpaceX said that they were going to be leasing out space to Anthropic, I believe at that point they said, look, we have all we need in Colossus 2 already to build out Grok. The broader thinking here, though, is, well, we can get plenty of money from folks who are just starved for capacity. If you look at the last couple of quarters from the hyperscalers, they've basically said uniformly that they just don't have enough computing capability to meet customer demand. So if you're a SpaceX and you don't necessarily need as much capacity and you can get a lot more money out of these other hyperscalers or other companies, these AI labs like the Anthropics or Google's, by renting out your data center space, well, that just makes sense for now. I mean, you can charge them an arm and a leg, and that seems to be the idea with what Meta is doing at this point. Now, that does raise the question, though, well, what happens to these AI models, right? Like, when does Grok get its training? When does it, right. What runs it? They just released a new version that is up there, not with Mythos class from Anthropic, but they say, I think, around Opus 4.6 or 4.8. Those are the prior models from Anthropic. So, I guess we really have to see where this kind of goes. Meta did the same thing where they released a new model they say is in line with Opus 4.8. So, they're still developing models, but I think at the end of the day, investors have to wonder, okay, are you a cloud business or are you going to be serving up these AI capabilities?
I guess the answer is all of the above.
It's like Airbnb for your data center. Rent it out.
Yeah, sure. Rent it out. Why not? All right, guys, thanks so much. Appreciate you hanging out here as we've been awaiting Federal Reserve Chairman Kevin Warsh, who has been speaking before the House Financial Services Committee. He has been giving his opening statement, which he is in the process of concluding, and he's going to be taking questions very soon. So let's listen in.
Questions. Thank you, Mr. Warsh. We'll now turn to member questions. I recognize myself for 5 minutes. As outlined in your statement, inflation is the result of many factors. Of these, the Fed has control only over one, monetary policy, as expressed through its interest rate and balance sheet policy. Today, a potential second surge of inflation is appearing due to factors outside the Fed's control. What the Fed can't control is how it reacts. Though upward pressure on prices may diminish on its own, it's not a sure thing. The Fed may be able to look through these inflationary pressures, but the Fed has believed that before and has been wrong. High inflation affects Americans in the here and now, not in some hypothetical future composed of long-term projections or of inflation expectations. Mr. Chairman, I was very encouraged to hear both in your testimony and your opening FOMC statement about restoring price stability as a top priority for you. When we think about that in the near term, though, how do you and your colleagues on the Open Market Committee plan to accomplish that given the policy tools at your disposal?
Well, thank you, Mr. Chairman. We want economic growth to be more broad-based, and we want the change in prices, the increase in inflation, to be more limited. There are a lot of things that are happening that are outside of our control, as you mentioned, conflicts overseas and the rest. We can't have and shouldn't have a direct control on that. But inflation's a choice. We monetary policymakers need to choose lower prices, and that's the commitment my colleagues have made. In direct answer to your question, I would say we're doing three things. One, commitment, which you heard at our first FOMC meeting, and I hope you heard today, is we're committed to the Fed to deliver price stability. We're committed to the 2% inflation goal. And so for businesses or households or market participants who came into this saying, well, they said before they were committed, but they seem to have tolerated a higher level of inflation, that commitment is resolute. Second thing that we can do is take ownership. This isn't a time for us to pass the buck, to blame others. The Federal Reserve can and will deliver price stability. We have the tools that you mentioned, both interest rates and balance sheet policy, that can help us achieve that aim. And we have the tools to deliver that. So it's a function of commitment, responsibility, and tools, and we're 3 for 3 and we'll deliver.
Thank you. I referenced in my opening statement about the 2020 decision on tolerating higher inflation and that it's now been abandoned by the board. Clearly, I think that was a policy error. It was praised by some at the time in August of 2020, but I found it alarming at the time it took place. First of all, do you agree with the FOMC's decision to abandon that? And secondly, how do you consider this past 6 years of experience when you look at the task force work on the framework question for looking at inflation?
Yeah, so there's no secret that at the time that the framework in 2020 was announced, the new framework, which was intended to get inflation higher, that at the time and in subsequent years before finding my way into this job, I was very critical of it. That central bank wasn't the first central bank to ask for a little more inflation and end up with a lot more. It was a mistake. The framework did not succeed in its objectives, and I am pleased that before my arrival, that my predecessors took that and cast it aside. All central bankers are going to make some share of mistakes, but when they make a mistake, they've got to call it out. Had that mistake been called out sooner, I don't believe we would have been burdened with this undue tax over the last 5 years. It's nearly the same degree. That's why we are reform-oriented. That's why my colleagues and I are so driven by these task forces to think about them anew. And in final response, I'd just say one of the task forces you mentioned is to revisit the inflation frameworks that the Federal Reserve uses so that we can better understand what will cause inflation to rise and fall and what we can do about it.
Well, thank you. And you also referenced courage in your opening statement, and you've just outlined the toughness of the set of policy choices that you and your fellow governors have. So difficult that your longtime predecessor, Arthur Burns, described that mission as the anguish of central banking to try to cope with the different structures. So in the last seconds I have left, will your task force work review the issue of what you have control over versus what is in the control of the Congress and regulatory and executive branch authority?
Yeah, I'll be brief in my response given the time. There's no anguish in central banking here, Mr. Chairman. We have the commitment, the power, and the responsibility to deliver on the mandate that this committee gave us, and we will. We've got full ability to do it, so you will not hear me blaming anyone else.
Thank you, Mr. Chairman. My time has expired, and I recognize the ranking member, Mrs. Waters, for questions for 5 minutes.
Thank you, Mr. Chairman. Chair Walsh, Section 10 of the Federal Reserve Act states, and I quote, "No member of the Board of Governors of the Federal Reserve System shall be an officer or director of any bank, banking institution, trust company, or Federal Reserve Bank, or hold stock in any bank, banking institution, or trust company," quote unquote. This prohibition ensures there's no conflict of interest arising from your role in making decisions as a regulator that could lead to your personal profit. Yes or no? Do you think that's a sensible prohibition?
Check your mic, Mr. Chairman.
Excuse me, ranking member. It's the law you've written, and it's the law we will follow.
Let me keep going. Vice Chair Baumann and FDIC Chair Hill testified last year that this prohibition is good public policy as it ensures that bank regulators serve the public's best interest and not their own. Now, unfortunately, President Trump undermine the independence of financial regulators, mandating the White House must now review and approve regulatory rules put forward by banking regulators, including the Fed, except when it comes to monetary policy. And instead of focusing on the job Americans elected him to do, the president grossly profiting off of his position to the extent the president and other executive branch officials now have a say in regulations in the Fed issues. Chair Walsh, should those officials be prohibited from owning any businesses where they have a role in regulating them, whether it is crypto company or bank or anything else? Yes or no?
So, Ranking Member Waters, I don't mean to disappoint you, but we're going to stay in our lane at the Federal Reserve. The more we stay in our lane, the more we stay out of politics. The rules and obligations for others outside the Federal Reserve are not something at which I feel it's appropriate for me to opine.
I have here President Trump's most recent financial disclosure, which shows that Trump made billions of dollars in the first year of his presidency, the bulk of which came from his family's crypto businesses, all while he is responsible for overseeing the agencies regulating crypto. This is an egregious conflict of interest, and Congress must put an end to it. Now, I want to just show you, in case you haven't had time to look yet, that this is the president's disclosure of his financial interests. This is, how many pages? 900. This is 900 pages of financial interest. When you have time, I want you to go through them so that you'll know and understand exactly what I'm talking about. So let me ask you, do you believe we must put an end to it?
Ranking Member, you've given us a big job. We've begun in 6 short weeks to tackle the big job, and I'm focused on that.
Well, let me just go further with the prediction markets. I'm deeply concerned by the potential for regulators to profit from the use of material non-public information on prediction markets. There's a pattern of insiders appearing to profit ahead of market-moving Trump administration decisions, like when officials with close ties to the administration make trades prior to major tariff announcements. Chair Walsh, what oversight does the Fed conduct over its employees with regard to insider trading? And given the rise of prediction markets, is the Fed increasing its oversight for its employees profiting from the use of material nonprofit information?
Ranking Member, at the end of my very first week on the job, I sent a letter to the 23,000 employees of the Fed, reminding them the best of the Fed's traditions, which is our culture. And included in that culture is integrity. Included in that culture is ensuring that we abide by the law and the very highest standards. That's a commitment that we've made to each other and will make to you.
Well, thank you. Chair Walsh, in 2019, I posed a simple question to former Chair Powell. I asked, if you get a call from the president and he said, I'm firing you, pack up and it's time to go, what would you do? Chair Powell said, of course, I would not do that. The answer would be no.
Gentlewoman's time has expired.
I asked further, he does not want me to go any further. Do you think the president doesn't have the
You can answer that answer. He can give you an answer in writing, and I'm sure he will do that in a timely way. Thank you so much. The chair recognizes the chair of our Task Force Monetary Policy, Mr. Lucas of Oklahoma. You're recognized for 5 minutes.
Thank you, Mr. Chairman. And Mr. Chairman, I want to start off discussing these task forces you've created. Clearly, Chairman Hill's Monetary Policy Task Force idea is catching fire as we see this go across the landscape. What do you anticipate the result of the task forces to be? Can we expect public reports or other documents? How do you envision presenting the results of these findings, Mr. Chairman?
Thank you very much. Right now, they're in discovery mode. I've given the 5 task forces a tall task to go back to first principles, see what we're doing, see what can be improved upon. They were starting with a blank sheet of paper, and you had a highly credible central bank running the most important monetary policy in the world. What would we do? Are there existing practices we could improve upon? Are there hard questions we could answer? The changes in the economy relevant to that? In terms of disclosure, we're going to make sure that the external independent task forces, which are staffed by some superb Fed staffers, that they get to share their views first with the decision makers. There are going to be 19 of us around the table that are committed to listen to them with an open mind and make decisions. But there's going to be nothing held in secret here. This is a public discussion on these 5, and I'm happy to share the results and the thinking periodically between now and the end of the year, at which point I hope we've got some real conclusions.
Of course, the committee task force is very sensitive on this thing. Let's move to the communications and balance sheet. A concern I raised with your predecessor is the potential for confusion on the purpose of adjustments to the Fed's balance sheet, absent clear and frequent communication. For example, the trading desk announced yesterday it's continuing the $10 billion in bill purchases this period, presumably to maintain ample reserves. I understand not wanting to preempt the work of the Communications Task Force, but can you share your thoughts on balance sheet policy communication? Will you make it clear to the markets when shrinking the balance sheet is intended to tighten monetary policy rather than a deregulatory effort to avoid market distortions?
Yeah. You raise a couple of very good points. First, that some of the boundaries of these task forces will overlap. In some sense, each of the task forces are charged with obligations that are ultimately the FOMC and the Board of Governors. So the Communications Task Force and the Balance Sheet Task Force, there might be some overlap in their work. But let me cut to the chase. The balance sheet policies since the global financial crisis when I last served, the balance sheet regime has changed quite significantly. The size and duration of assets the Fed's holding have changed massively. They changed first in a period of crisis. That was the design of this new balance sheet policy. I don't want to prejudge decisions that this task force makes, but it's no secret of my long-held views, and I'll just state them 3 ways. One is the balance sheet is part of monetary policy. Monetary policy is made both through interest rates and through the balance sheet policies. The balance sheet isn't merely about plumbing. So that's point 1. Second, I want to assure you that if there were a change in balance sheet policy, that we would preview it, explain it, debate it, and no changes in balance sheet policy would happen without good advance notice to the likes of this committee and broadly financial markets. And 3, as we think about balance sheet policy, we at the Federal Reserve have to do, I think, a strong and compelling job to stay clear of fiscal policy. We want to be out of the fiscal policy business, which is between you and the Treasury Secretary and the President, and focus on monetary policy. Those are among the big questions I've asked this group of 3 distinguished leaders to take on, and I look forward to hearing what they have to say about it.
The composition of Treasury purchases continues to trend towards more price-sensitive market participants. The MPR details this trend along with the strong demand and increased liquidity, though we know from experience conditions can worsen quickly in the crisis. How are you thinking about financial stability and the threat of fiscal dominance as Congress fails to get spending under control while the demand for our debt, including the Federal Reserve, continues to change?
So it's an excellent question. As we sit here today, the average duration, that is the average outstanding stock of assets that are held by the Fed and U.S. Treasuries is about 6.5 years. The Treasuries that held in the market are about 4.5 years. I understand in periods of crises, like the 2020 pandemic and the 2008 crisis, central banks by design needing to step into markets to create a fair price. But in more benign times, when our overall holdings are larger than the market, that's something where monetary policy is, in the language of former Chairman Volcker, on the edge of its authority. These are among the questions that this task force will look at.
Thank you, Mr. Chairman. Yield back, Mr. Chairman.
Gentleman yields back. Chair recognizes the ranking member of the House Small Business Committee, Ms. Velasquez of New York, for 5 minutes.
Right here. Welcome to the committee. I would like to start with a straightforward, simple question. Do you work for Donald Trump? Yes or no?
If I'm permitted to say, we're an independent central bank. We're honored to be independent. Our independence came from you.
Okay, that's enough. Thank you. What steps would you take if the president or others in the administration target you or your fellow governors because he doesn't like how many of them are voting on interest rate policy.
So it's not my intuition to engage in hypotheticals, but I'll tell you this: the Supreme Court said
that's an easy way out.
The Supreme Court said that the Federal Reserve and the conduct of monetary policy is independent. To the extent there were questions about it, the courts answered those questions.
So what would you do?
I would continue to do my job.
Okay, good. Chair Walsh, do you agree that current monetary policy exists in an extremely polarized and politicized environment?
Outside the four walls of the Federal Reserve, there's no doubt a lot of politics. But my goal inside the central bank is for there to be no politics. To the extent there's politics there, we're going to get rid of them.
Well, I, along with many on my side, will say that the attempted firings of a sitting Fed governor and Fed chair in the central bank's 111-year history is quite the politicization and polarization of the Fed. Chair Walsh, at your nomination hearing a few months ago, you said, and I state, I am committed to ensuring that the conduct of monetary policy remains strictly independent. You just said that. Are you still committed to conducting independent monetary policy today?
Absolutely.
Given the current mistrust of government and the political environment surrounding your appointment, the decision to limit communications and offload Fed objectives to clandestine task forces with no clear transparency calls your motivations into question. Can you commit today to institute an explanatory framework that details the reasoning of the Fed's actions following policy changes?
Yeah, I'm here today, Congressman, to do just that. And I think I've demonstrated in my first 6 or 7 weeks in office a commitment to independence and a commitment to reform. Those two are of common importance, and I'm going to deliver on both of them.
I'm glad to hear that.
Thank you.
Chair Walsh, at your first post-AOMC meeting as chair, you were asked how you intend to handle Fed communications going forward. You answered, and I quote, "We made some changes today. I expect more changes to come, and some of those might well be worthy of a press conference." To me, that is not a very definitive standard. Can you commit today to creating a fixed public standard for which FOMC decisions and procedural changes trigger a press conference rather than deciding case by case which ones might be worth it? Yes or no?
So if I can be a slightly longer than yes or no, the last 63 months, maybe 64 months of high inflation above the Fed's objective suggests that it is immediately important to think about reforms, including in communications, and that's what we're going to do. I don't expect any of the change in communications to be about hiding the ball. The purpose of a change in communications is to do one thing right, which is to get monetary policy
I
right.
hear you, but are you instituting any standards that will qualify for a press conference as a worth news for the public and hear us in Congress?
So in a word, yes, and we have a task force that's going to help us think about how to do that and do a better job of getting policy right, and making sure that you know what we're doing and why.
Can you give me a single objective or criteria right now on how you will determine whether or not a change at the Fed is significant enough for you to hold a press conference on it?
Mr. Chairman, I'd invite you to answer that question in writing, please, for the gentlewoman from New York. Chair recognizes the gentleman from Texas. Mr. Sessions, you're recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome. We're delighted that you're here. This is your first time here, but you'll get used to coming back. You'll be here twice a year. So your report to Congress is important, and we do count on the factual nature of that. I'd like to refer, if I can, to 3 questions and allow you to speak instead of myself most of the time. Number 1, housing interest rates, that would be on page 21 and 37. Then understanding better the agricultural stability of that marketplace. I represent a hugely agricultural district. And second, or lastly, the labor market outlook, that's page 16. I'll let the gentleman please move forward, and I'll prompt you now on the first one, housing interest rates. You would please talk to us, your view of that. It's higher than what I want, but you're the person that's in the seat today.
So as I mentioned in my opening statement, prepared remarks, the economy is solid. Financial markets look like they're in very good condition. But when we look at housing markets, the story is much more uneven. 30-year fixed rate mortgages, which is really the relevance of much of this discussion to a lot of hard-working Americans, it's higher than it's been, and in part, that's because of inflation that has been above the Fed's objectives.
Okay, and looking forward?
So we have
your goal. What can we look at you and say, what is our new chairman going to do about that?
So he's going to deliver price stability with his colleagues at the FOMC. And what we can do in making sure that people are confident that the change in prices is at such a level they don't have to think about it and they don't have to talk about it. That is consistent with long-term treasury yields being lower, and that's also consistent with mortgages being more affordable.
Well, I agree with that, and I'll look forward to that. Agricultural outlook, as you know, farmers, the farm economy is going through some changes. Your viewpoint on that?
As you know, the Fed does not target particular sectors, but that doesn't mean these sectors aren't incredibly important. The housing economy matters to the economy, the overall economy, and so does the ag economy. It's the breadth and diversity of the U.S. economy that gives it its strength. It's the dynamism of what's happening in each of these sectors, including in agriculture, that gives us great comfort that economic growth can be materially higher than it is. We are not afraid of productivity-led growth, and that's not unique to AI. That's across all sectors of the economy. As I mentioned to Chairman Hill, we're looking for growth to be broader, and the change in prices, the inflation in prices to be more limited. Agriculture is not immune to either of those developments.
Well, the Agriculture Secretary has been added to some of your important committees to make sure there's discussion. I hope that you will listen to her. It is important for you to understand that when people talk about the stock market or investment, farmers and ranchers look out in their backyard at the cost of their equipment, at the cost of their land, at the cost of things. They don't have a stock market. They have their own investment. And I think that the Secretary can be there to completely continue to remind you of that. Labor market outlook really looks good. Page 16, sir, your take.
Yeah, so the labor market has been remarkably resilient. The increase in nominal wages has been solid. You might have heard in my comments at the beginning of this a bit more focus on the price stability part of the mandate. I want you to know, though, that there is no disfavored part of the legislative remit that you gave us. The dual mandate is your word to us that we're going to focus on price stability and on full employment. I intend to do just that, and if I could add one other thing, in my view, the two parts of the mandate are not in conflict. This is not an either-or proposition. The more we can do to deliver low and stable prices, the more we can get it such that people aren't worried about inflation, the more employers are going to want to hire more workers. So you gave us a remit. We take both parts of it seriously. As we look out the window now, the labor markets look to be in pretty good balance. We've got some work to do on the inflation front.
Well, we in the One Big Beautiful Bill encourage people to go back to work. And that is why we do not tax overtime pay and why we do not tax what would be tips. We need to get people back in the marketplace. We hope you helped us out, Mr. Chairman. Welcome to us, Mr. Chairman. Thank you for your time.
Gentleman from Texas yields back. Chair recognizes the ranking member of our Capital Markets Subcommittee, Mr. Sherman of California, for 5 minutes.
Mr. Chairman, first I want to commend you for looking to improve the data on which you base your monetary policy decisions. Up until now, we've relied on survey data as a substantial part of that, and increasingly Americans just don't voluntarily answer survey questions. I want to commend you for declaring your independence. We saw what happens in Argentina, Venezuela, and most notably Turkey when federal central bank independence is eroded. I would say ironically that had your predecessor caved to Trump and lowered interest rates below what economics would call for, we would have much higher inflation today, and that would have been bad for Americans. It would have been absolutely terrible for the Republican Party. So the independent, your agency has saved Donald Trump from himself. And finally, I would say don't rely on this distinction between the Cook and the Slaughter cases. The idea that every congressionally created independent agency isn't independent except yours, you don't want to be relying on that. The distinctions the court makes between your agency and every other agency are rather weak historically. Our capital markets support our business expansion and our economy. Money market funds are an important part of that, buying short-term commercial paper from corporations. Our payment system is designed to meet the needs of honest Americans. That's why we have an anti-money laundering, know your customer rule that makes it a bad system for drug dealers, sanctions evaders, et cetera. There's a rival to these institutions, and that is a cryptocurrency, which literally means hidden money, and is designed to, and then we have in particularly stable coins, which are just like a money market fund, except you earn zero interest, and everything is hidden. Now, the Federal Reserve established liquidity facilities to support money market funds in the last crisis. Will the Federal Reserve support cryptocurrency or stablecoins if they face a run-on from investors?
So, Congressman, thank you for mentioning many of those issues. We talked about a lot of them in your office, so I appreciate it. I still have the scars from the 2008 financial crisis.
We all
still have the scars from the extraordinary efforts that my colleagues and I, under Chairman Bernanke's leadership, had to do. That is not something we want to repeat.
Can you assure us
that we need
that you will not be bailing out stablecoin and cryptocurrency?
So I don't want to, I can be more broadly than that. We do not want to be in the bailout business, full stop.
But your predecessor did provide a liquidity function for money market funds. If, God forbid, we faced a similar circumstance in the crypto world, would you bail them out?
So I want to be very clear. We're going to do everything we can to mitigate those sorts of extraordinary risks. If and when they were to come in the next 4 years, we want to be in a position we're not bailing out anybody, including crypto.
You're not really answering the question. Obviously, everybody prefers our economy works well. And I'm certainly concerned with giving non-banks direct access to the payment system, and this Kraken filing with the Kansas City Fed is concerning, but I want to move on to Basel III. Your predecessor said that the capital requirements for banks in 2019 were about right. The current reproposal substantially raises those capital requirements. Were capital requirements about right in 2019, or should they be higher than that today?
So the good news is we have a proposed capital rule that's out for comment. I'm quite interested in getting the reports and the comments on that, and I look forward to reviewing those and making a judgment. I would say, as a first principle, strong capital ratios, strong liquidity ratios, strong supervision, and strong market discipline, they're all of a piece to ensure we don't find ourselves in a world where there's unsafe or unsound institutions.
We, of course, want strong limits. On the other hand, if you go overboard, you hurt economic growth and hurt the economy. I hope in that review process you'll look at low-income housing tax credits, where you've already moved from 400% to 100%. It should be closer to 20%. These are very stable aspects.
Gentleman's time has expired.
My time has expired.
Appreciate you, Mr. Chairman. The chair recognizes the chair of our subcommittee on financial institutions, the distinguished gentleman from Kentucky, Mr. Barr. Thank you, Mr. Chairman. And Chairman Warsh, congratulations on your confirmation and swearing in as the 17th chairman of the Federal Reserve. I am grateful for your commitment to reforming the Fed, and that appreciation is surpassed only by our shared love for Kentucky thoroughbreds and your love of the great sport of horse racing. Let me just ask you, first of all, since you're swearing in over 7 weeks ago, things seem quite a bit different over at the Fed. A few examples: elimination of forward guidance, abstaining from the dot plot, creation of these 5 specialized task forces, and maybe most impressively, taking accountability. Instead of blaming inflation on the pandemic or supply chain interruptions or tariffs or the Strait of Hormuz, you are saying that inflation is always and every time the result of the Fed supporting printing too much money. Tell me, Mr. Warsh, you appear to be quite different from your predecessors. How are you different?
So I've known 5 of my predecessors. I've learned particular lessons from each of them. I can only be my own man. I served before at the Fed for about 5.5 years under Chairman Bernanke, and I learned a lot of things then. But you're right. In 6 weeks, we have caused, I think, a sea change in new thinking, the beginning of a set of reforms that are going to be put in place across at least 5 dimensions in monetary policy. And it's a broader discussion about reforms that will be forthcoming in everything we do, including supervision and regulation, where there's already been a good start, in payments and the rest. We made a lot of progress in 6 weeks, but I think it's important to use this opportunity wisely. The 63 months of inflation above target has been an unfair burden and has been a tax on the American people and businesses. We plan on getting rid of that tax. If that means we need a regime change in policy and we need new consideration of practices, some of which have been working, some of which haven't, that's what we aim to do, and we're just getting started.
Well, I appreciate your commitment to being different. Let's talk about overhauling Fed communications. This from a Wall Street Journal editorial on June 15th. They write, few innovations since 2008 have been as counterproductive as the adoption of forward guidance as a policy tool. The constant yammering, long policy statements, press conferences after every FOMC meeting, nonstop speeches by Fed officials, and above all, the quarterly summary of economic projections has exposed how little the Fed understands about the economy and trapped officials in errant policies. Chairman Warsh, why is it important to do away with the dot plot and end, once and for all, forward guidance?
Well, Congressman, I've made no secret probably over the last 15 years of my views on communications. I think when central bankers speak like I am before you, it's either one under obligation or in this case under obligation and purpose, which is to share a set of new reforms so that American households and businesses might say to themselves, this is a regime change in policy. We're only beginning it. I'm keenly interested in the views of these 5 task forces. And ultimately, these are decisions that are going to be made jointly. The best of the Fed's traditions are to work collegially, and I've really been quite impressed how open-minded my colleagues have been to take it up, specifically in communications. If we were to share with you our every passing thought, I worry not that there's anything wrong with us, but we're human. And if we were to give you my projection today about what we'll do when we meet in 2 weeks, what we'll do over the course of the year, that we then find ourselves sort of taking information that's consistent with our priors and rejecting information that's inconsistent. It's not the way we want to do things. We want to get policy right, And I think being somewhat more circumspect in our communications, at least for me, is a better way of calling balls and strikes.
Finally, thanks for your commitment on dealing with this mission creep. In recent years, the Fed has concerned itself with matters outside of its dual mandate, including diversity, equity, inclusion, climate change, and the like. That's why the Fed's joining the network of the greening of the financial system distracted the Fed from the very important job of price stability. How will you keep the Fed from rejoining the network for the greening of the financial system or veering into these peripheral and distracting matters that go beyond the statutory remit of the Fed?
By being very clear of our obligations. You told us that our job is full employment and price stability. You gave us plenty of other hard work to do. We'll have a series of reforms outside of monetary policy. Our plate is full. We will not be wandering into other areas, I can assure you, Congress.
Thank you. I yield back. The gentleman from New York, the ranking member of the House Foreign Affairs Committee, Mr. Meeks, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And congratulations, Mr. Chairman. You just jump into this because in your testimony, you talked about the Federal Reserve's, and I quote, rightful independence in the conduct of monetary policy, which is good. Now, as the Chairman Hill has indicated, I also do some foreign affairs work. And I'm very concerned about what's taking place in the Strait of Hormuz and rising cost of gas, because we know that when those prices go up at the pump, it gives higher transportation and energy cost, and they work their way through the economy, generally making groceries higher-end household goods, et cetera. So it depends upon handling it. So if the administration's handling of the conflict with Iran contributes to another inflationary shock, will you make the decision you believe is in the best interest of the American people and the American economy in that rightful independent stance?
Congressman, that is always our commitment, to make the best decision we can, consistent with the remit and our understanding of the world. And as I said to the chairman at the outset, we'll deliver price stability.
So, and that's, still based upon what we've seen from the president thus far. Now, I just want to be clear, make sure that, because I got to be clear on this, that if the president publicly pressures you to pursue a different course than the one you believe is in the economic, that you believe the economic data supports, will you follow the president's wishes or follow the data?
My commitment to you is to follow the law and follow the data, follow our very best judgment.
And that's even if he publicly criticizes you for doing it. If you decide this is the way to go, this is what the data shows, and he publicly criticizes you and tells you how disappointed he's in you and all of that, will you still do what the data tells you to do?
I will, Congressman.
You ready for that?
I'm ready to follow the law, and I'm ready for the Fed to deliver on the expansive remit that you gave us. I'll make only one other note. We have a wide lens. We're interested in what's happening in the war. We're interested in what's happening in military conflicts around. We have to take that all in, but then we have to shut the door and make our very best decision. That's what we're going to do in a couple of weeks, and that's what we'll do in the remainder of my tenure.
Thank you. So now I want you to know that I support innovation, but I also believe that the Federal Reserve has a responsibility to protect the integrity of our payment system from political pressure and short-term enthusiasm. And I believe that the administration has made expanding access to fintech and digital asset firms a clear priority of his, but the Federal Reserve has long evaluated access to its payment infrastructure based on safety and soundness, operational resilience, and effective risk management, and the stability of the financial system. Not politics, not political priorities. So can you, and what I should say this also, because what I'm concerned about is that there are firms that's connected to our nation's payment infrastructure that must have robust cybersecurity, fraud prevention, compliance, and operational controls, because failures can undermine public confidence in the financial system and leave consumers exposed to significant harm. So my question is, can you commit that decisions about access to the Federal Reserve's payment rails will remain grounded solely in the Fed's independent assessment of systemic risk, safety, and soundness, and not political direction?
We're going to keep politics out of the Fed. We're going to stay focused on the responsibilities you've given us. And I think you highlight something very important. This new technology revolution, which is hitting the Federal Reserve and the economy, provides huge opportunities. The United States can lead in payments. Our economy can be the strongest in the world and improve its growth rate, but it's not without risks, and we at the Fed are going to strike the right balance between the challenges and the opportunities in payments and more broadly.
Let me just ask this, I got 28 seconds, but what objective standards must any firm satisfy before you conclude that the benefits of innovation outweigh the risks to consumers and the broader financial system?
I like the way you think. A benefit cost test is a good test for economists like us, and if the benefits exceed the cost, then that's the kind of policy, procedure, and objective we want to pursue.
Thank you.
Thank you, Congressman.
Gentleman yields back. The chair recognizes the chair of our Capital Markets Subcommittee, Ann Wagner of Missouri. You're recognized for 5 minutes.
Hi, thank you, Mr. Chairman, and welcome, Chairman Warsh, and congratulations to you. My work on the Capital Markets Subcommittee as chairman has been focused on giving the American people and our small businesses more options and access to our markets, giving the everyday investor and the local employer better opportunities to grow their financial future and kind of on their own terms, I'd say. Under the previous administration, we saw a heavy-handed regulatory approach that aimed to strip risk out of our markets entirely. And time after time, the Biden-Harris administration pushed policies that limited financial freedom and stifled growth. Our capital markets are, as we all know, the envy of the world, and that is because we allow Americans to weigh risk and reward for themselves and make the financial decisions that are best for them and their families. Chairman Warsh, at a high level, how do you view the Fed's role relative to the financial system, both as a central bank and as a bank regulator? And I guess what I mean is, should the Fed try to engineer all risk out of our economic system, or should it act as a prudent observer that only intervenes when truly necessary?
So, Congressman, it's a leading question, which I can answer with a we need to strike the right balance. We are not trying to take risks out of markets in normal times. The economic growth that I mentioned to your colleague just a moment ago comes about because of a certain dynamism in our financial markets, which comes from a dynamism in the real economy. That isn't created by the Federal Reserve, but we can be a foundation with clear, steady policies, delivering on the remit that you gave us so that the American spirit and American economic growth can continue to be the envy of the world.
Something on the top of mind for myself and certainly for my constituents in Missouri's 2nd Congressional District is the state of the economy, including the cost of living, job growth, and interest rates. Though it is often characterized as being tasked with a dual mandate, the Fed, in fact, has multiple statutory mandates, including stable prices, maximum employment, moderate long-term interest rates, and financial stability. When the Fed leans into one of these goals, sir, it can create ripple effects on the others, forcing a balancing act between competing priorities. Chairman Warsh, how do you weigh these different mandates and the trade-offs between them?
So I'm a little different than some in the economics profession on that, Congressman. I do not think we have a cruel choice between stable prices and full employment. I think the mandate that you and Congress gave us are entirely consistent. If we can ensure stable prices, the American economy can thrive, businesses can hire more employees, and the dynamic economic engine we talked about can continue to be the envy of the world. I don't think we have to run a balancing test. I don't think it's an either-or proposition. We're in the business of doing what we can to ensure financial stability over a business cycle and financial cycle. And we're always in the business of ensuring stable prices and full employment. At different times, our focus, our lens has to turn to one of those priorities, but I think they're entirely consistent with each other.
Which leads to my next point here. There are some who believe, Chairman Warsh, that the Fed should be used as an everything regulator, where instead of acting as an observer of markets, the Fed attempts to actively manage them beyond its statutory responsibility. Chairman Warsh, how does this mission creep affect the Fed's reputation? And should the Fed take actions beyond those specifically authorized in federal law?
We should follow the law. There is a tendency when circumstances get tough for any regulatory agency, any agency to go to the edge of their authorities, but that's when politics enter the door. My objective, the objective of my colleagues is to keep politics out. And the way we do that is we steer clear of things that we aren't authorized to do.
Gentlewoman's time has expired.
My time's expired, and I think that's the answer we're looking for. I yield back.
The chairman recognizes the ranking member of our subcommittee on digital assets, Mr. Lynch of Massachusetts, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chairman Warsh. Good to see you. My congratulations. I was pleased to see that in your opening remarks, you spoke to the issue of artificial intelligence. And as the ranking member on AI and crypto, I was just curious to try to tease some more of your thoughts out on that. Not only in the financial services context, but AI in general. I mean, in the past, the Federal Reserve has been able to identify risks of impact to the financial system, but also in a wider context as well. And I wonder if you'd share some of your concerns about that. And I guess I'd like to know, under your leadership, what will be the Fed's approach on AI and how you protect the system from some of the risks that may be attendant to the adoption of AI.
Yeah, thank you, Congressman. We talked about this a bit in your office, and I appreciate the time. This is perhaps the most significant change in our economy in my adult lifetime. I take the new investments in intelligence, in some sense, to be one where we have to recognize it's a huge opportunity, but it also comes with risks and challenges. It is not the job of the central bank to provide or be certain of what the consequences are over the next 12 or 24 months. But we recognize that the United States is likely to be a big winner. The United States is at the forefront of these technologies. Both the human capital and the capital provided from investors are happening here. So the efficient frontier of these technologies are happening in the United States. This is a benefit broadly to our economy. But I don't want to sound overly complacent about it. These technologies also offer threats when they find their way into adversaries' hands. The infrastructure at the Federal Reserve, the infrastructure at our banks, large and small, they must feel new pressure as people are looking to use these technologies to do harm. So these technologies can be used for good and for harm. Over the long term, I think the U.S. is the winner. Over the long term, I think there is a material improvement in productivity, which should have a material improvement ultimately in wages and the strength of the economy. But the long term it can be quite far out, and we've got to monitor things month by month, quarter by quarter as we get there.
Yeah, the thing that troubles me is every time we talk about AI, I hear about this race, and it's us against China, or it's us against South Korea, or countries in the EU. The problem with that thinking is that in this race, and we're seeing the velocity of change is enormous. It's exceeding obviously our ability to regulate AI. At the end of the day, I don't see the United States as the winner. I don't see China as the winner. I see artificial superintelligence as the winner. That's where we're rushing along this course, And at the end of the day, we're creating either us, and it doesn't matter whether the creator of artificial superintelligence is a good guy or a bad guy, or a good gal or a bad gal. That superintelligence itself will be the entity that we have to confront. And I just worry about the broader impact of what's going on right now. There's tremendous resources, as you know, being poured into AI. I just hope that the course of regulation does not meet the same fate that the regulation of crypto did, where the crypto industry spent close to $250 million up here on Capitol Hill, and they got the bill they wanted. If that happens with AI, we are in serious existential trouble, not only in this country, but in this world. And I do believe that the Fed, in your position, has influence, has the ability to seek out those dangers that others may not identify. And I just ask you to please consider your role and the resources that you have, that maybe you can put a task force together to look at the broader implications of the adoption of AI. They can't even show us, they can't even explain some of the things that they're using right now. The explainability gap is enormous, but I welcome you. I wish you the best. I really do. I wish you the best for all of us.
Gentleman's time has expired.
I yield back.
Chair recognizes the gentleman from Georgia, the Vice Chairman of our Financial Institutions Subcommittee. Mr. Loudermilk, you're recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Walsh, welcome. Thank you for being here, and Godspeed with the position you now have, and we wish you the best of luck.
Thank you.
First, I want to talk about Operation Choke Point. As you are fully aware, Operation Choke Point 2.0 involved partisan actors at the Fed using, as a quote, reputation risk as a means to target and debank firms and individuals in the digital asset ecosystem. The energy industry, and really anyone that partisan actors at the Fed believed unworthy of a bank account or loan. This was especially egregious given the fact that the Fed does not have a statutory authority from Congress to supervise for reputation risk. While I'm happy that reputation risk has been wiped from the Fed's guidance to examiners, can you please tell us what steps the Fed can take to durably ensure that statutory silence is never again abused by partisan actors to attempt through the Fed what they cannot make through law in Congress, and also what actions that you may be taking?
Yeah, so thank you, Congressman. Reputational risk has been removed from the dashboard that supervisors and regulators will have anything to do with. My view is that being a good supervisor and regulator is tough business, and we don't need to make it harder by bringing politics into it. Vice Chair Bowman has begun a series of reforms before I arrived in this, and I think you're going to find in the coming quarters and years we're going to continue to reform and refine our regulatory system so that we can have a safer and sounder financial system, and I'll add a more competitive one too.
All right, thank you for that, and we appreciate your work in that area. The Fed currently holds a considerable share of federal debt and has for almost 2 decades now. With a ready buyer and low interest rates, it's not surprising that Congress has been incentivized to run up large and growing deficits over the same time frame. You've spoken before about the Fed's role here and the threat of monetary dominance and fiscal dominance. How can the Fed get out of the business of underwriting Congress's fiscal irresponsibility?
One thing we can do is think hard about when we're going to be buying debt from the Treasury. This might not sound like perfect virtue, but when we have a crisis like in 2008 and 2020, my view is you created the central bank to take extraordinary actions. In more normal times, in a more normal business and financial cycle, fiscal policy needs to be a decision that you make with the administration. The Fed should have nothing to do with it. I've set up a task force to focus on the balance sheet, to ask the question first, what's the effect of the balance sheet on the conduct of monetary policy and ultimately inflation? Second, what are the pros and cons of different regimes I'm not of the mistaken view we can go back to where we were when I arrived at the Fed in 2006, but I think there are several other sustainable equilibrium we can achieve. And the third question is equally important. It took us nearly 18 years to find our way into this balance sheet. We're holding a lot of long-term treasury debt, long-term mortgage-backed securities. We won't be able to make changes overnight. Any changes that we make would be well deliberated, would be public, would be understood, and there'd be quite a bit of time before any of that was operationalized. I look forward to the recommendations of the task force, and I look forward to hearing from my colleagues around the FOMC as we contemplate alternatives.
Well, thank you for that. And what are your greatest concerns with regard to the threat of monetary dominance?
Yeah, so you have a different job than we do. The independence that many of your colleagues have spoke about this morning is a political and economic decision to give us the pen on interest rates, to let us be the deciders of monetary policy. I've always taken that as part of a bargain. You're giving us independence in that, and my judgment is we should be staying out of fiscal policy. We shouldn't be weighing in, no matter how tempting it might be, either directly by buying assets that have some flavor of fiscal policy, or by opining on subjects that really isn't our business. We're going to try to stick in our lane at the Federal Reserve. We've been good at that for the last 6 weeks, but there's always a temptation to wander in other areas. I'm going to try to be reserved in my comments on fiscal policy with you and your colleagues. That's your job, it's not mine.
Well, thank you for those answers. They're very thorough and very refreshing to hear. And with that, Mr. Chairman, I yield back.
Gentleman yields back. Chair recognizes the gentleman from Houston, Texas, Mr. Green, who is a ranking member of our subcommittee on oversight and investigations. Mr. Green.
Over here, Mr. Chairman.
Thank you.
Thank you, Mr. Chairman. I thank the ranking member as well. And I welcome you to the committee, Mr. Chairman, but I would also say to you that I will pray for you. And I'll pray for you because many of the questions that have been predicated today hinge upon a belief that you will sanction the president's desires. It is thought among the general public that you're in the position you're in because the president could not have the influence that he wanted to have with the prior chair, and he believes he can have it with you. So I hope that you will stand firm and honor your commitments that you're making, though some of them are not firm commitments as I understood your language. You indicated that you're interested in war. I appreciate this, but I believe you should also be interested in speculative bubbles. My assumption is that you are. Are you interested in bubbles, speculative bubbles, Mr. Chairman?
We've got a wide lens. We spend a lot of time thinking about what's happening.
I'm going to take that as a yes. Now, given that you're interested in speculative bubbles, let's just talk about a bubble that occurred. President Trump's meme coin, $Trump, profited an average of $1.74 million per day over his first year. $1.74 million per day. This amounted to approximately $636 million in total royalties and licensing fees generated at its launch. While this was happening, during that same period of time, nearly 1 million investors lost a combined $3.8 billion. This is because that meme coin lost value, dropped precipitously in value. It was a bubble, by the way. It is nothing. Anybody who's listening to me, if you've invested in a meme coin, you've invested in nothing. Zero. In a righteous world, it would be illegal. But given the Secretary of the Treasury that we have currently, it is not. And that's very unfortunate. SEC, Secretary of the SEC. It is not. I think that we should concern ourselves with these speculative bubbles. And whether you like it or not, you have to concern yourself with it because when you lower interest rates, you lower the rates such that there's more capital available for people to use for speculative reasons. So you have to be concerned about it whether you want to or not, because you don't want to see a speculative bubble. Can I have your assurance that you will be concerned about these speculative bubbles, Mr. Chairman?
So, Congressman, we want a resilient, strong, safe financial system, and we are looking at financial markets and we're looking at the real economy to make sure we deliver on what we can. Some of these other subjects are really more in your purview and responsibility.
They're in my purview, excuse me for interrupting, but I have to. They're in my purview, but only because I choose to have them in my purview and I make an issue of them. I have to vote on them. But they're in your purview too, because you decide whether the rates go up or down. And if you lower them, then people can engage in these speculative bubbles, such as the Trump meme coin, and they can lose a lot of money, losing billions of dollars while the president makes millions on a daily basis. This is the epitome of ridiculosity. At some point, we all have to take a stand, Mr. Chairman. This is going to be your opportunity. You're going to have to take a stand at some point, because this president is interested in making money. He puts money ahead of the people of this country. The people of the United States of America are secondary when it comes to the president. They may even be tertiary or quaternary, but they're not first. And at some point, you're going to have to make a tough decision as it relates to this president. Look, I'm not going to prejudge you. I'm going to assume that given your statements and the latitude that the Supreme Court has given you, that you'll make the right decision. But you're going to have to be concerned about a speculative bubble, especially as it relates to crypto. This is something that we'll all have to address. I thank you very much.
Gentleman yields back. Chair recognizes the Vice Chairman of our full committee, Mr. Heisinger of Michigan, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Warsh, congratulations. I join many of my colleagues in seeing you there as a very positive thing. In late 2021 and 2022, as has been referenced by a few others, the Fed had recognized inflation was not transitory. I'm reminded of actually a hearing we had where we had then Secretary Yellen, former Fed Chair Yellen, sitting next to the then current Fed Chairman. And when I brought up the question about whether it was transitory, they did not have the same answer. And it was interesting seeing how that lag, and it sort of played into the fear that many of us had that there had been more to this foot dragging coming out of the Biden administration. The quick question is, while the appropriate speed of a response depends on what is driving inflation, I think you would certainly agree. I'm curious your view of how the Fed should make that judgment and act quickly once it does, because I think, as has been pointed out, there was a lag.
So, Congressman, I appreciate the question. We only look to the past for lessons learned. We're not trying to relitigate the decisions that are made of our predecessors, but the reforms that I've already announced in communications, the task forces that have been established, are an attempt to make the conduct of monetary policy better, swifter, more sound, so we can deliver price stability. Our number one objective is to get policy right. And my judgment, as I said to one of your colleagues before, is that demands an open mind. That means not pre-committing to decisions before we take it up inside the four walls of the Federal Reserve. And so you'll hear from me a lot less forward guidance and a lot of listening. Generally, as a practice, what we're going to try to do, especially at the beginning, is deeper, more serious discussions among us, fewer pronouncements.
So I appreciate you don't want to relitigate the past, but I do think, as we all know, we also learn from history. And during the previous administration, the Fed took some pretty major regulatory actions, some within its statutory authority, and in my view, maybe excessive, but others that were clearly beyond what Congress had really authorized. And everyone agrees a safe and sound banking system is essential to monetary policy, the economy, and the American people. But when the Fed exceeds its statutory authority or reinterprets old laws to claim new powers, that to me is mission creep. Can you assure us that future bank regulatory proposals will respect the important procedural guardrails established by the Administrative Procedure Act? The APA has been in many ways trampled, I believe, which often received only nominal consideration under the previous administration. How are you going to handle this?
So we're going to follow the law just as you say. You've established a set of laws. There's a set of regulations by which changes in supervision and regulation, changes in guidance can be made. We intend to follow them with an objective, as you mentioned, of a safe, sound, and again, I'll add, competitive banking system. There's a huge strength for the United States, and our banking system is stronger and more resilient than most around the global economy.
Expound a little bit about your views of the importance of a banking system to the American people and the benefits to them of a Fed sticking to the authorities that Congress has given it, and rather than going far afield.
Yeah, so we've got to keep politics out of the Fed. Politics can find their way into the Fed through any of the range of powers that you've given us. Our supervisors and regulators have a lot of authority over the thousands of banks that are regulated in the United States. Explicit authority and also authority when they knock on the door and they ask a series of questions. One of the great strengths of the U.S. economy is the diversity of institutions we have in the banking business. Most of the G20 counterparts we have, they have a handful of banks. They're implicitly backed by their government. One of the untold strengths of our economy is the diversity of our banking system. We've got regulators that need to ensure that the regulation and supervision are tailored to what happens in those institutions. One size fits all might work for other countries. It doesn't work in the US. And the vision I have, Congressman, is liquidity and credit that comes up from the real economy through the banks.
Thank you.
And gets aggregated, not top-down liquidity provided by the Federal Reserve.
Thank you. I yield back.
Thank you. Chair recognizes the ranking member of our subcommittee on housing and insurance, Mr. Cleaver. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Let me first, before I ask any questions, express my personal appreciation for you and Ranking Member Waters for allowing and giving my partner, Mike Flood, and I the opportunity to go out and deal with this housing issue that, frankly, I think is going to add a whole new dimension to our ability as a federal government to increase this human need for housing. So thank you very much. I appreciate, and I know he does as well, all of the freedom that you guys gave us. Thank you, Madam Ranking Member. Mr. Chairman, congratulations for your new step and your career and for being here. I appreciated having a good conversation with you prior to this hearing. And I'm sure that you're not surprised that there's a great deal of interest in independence. And in theology, you said there are 4 endowments of the human species, and one of them is independence, that we have an independent will. And I'm interested in a declaration of independence, if you will. Wax eloquent on your view about the independence of the Federal Reserve.
So the independence of the Federal Reserve is sacrosanct. Part of the reason for the Fed's power comes not just from a printing press, though it can be useful from time to time. It comes from our credibility to make the best choices we can, consistent with the law that you've written for us. And that credibility is bolstered if we are and are perceived to be independent. And so that's a commitment I can make to you, because that's the way we can best do our job.
Thank you very much. Independence is a big deal in the real world, and then certainly with the Federal Reserve. But I also have to say that you know, there is a terror of the unknown as part of who we are. And the oldest and strongest of the human emotions is fear. It's almost the first thing we have. Even babies will jump because there's a fear of falling. Even they may not even realize they're in the world, but there is this fear. And I'm not sure what to call this, maybe AI anxiety, but I clearly have it. And it's only, my youngest son is an actor, and it would be inappropriate for me to tell everybody here to watch Sweet Magnolias on Netflix. However, I am concerned, he's concerned, as many of the people in that business, about what AI can do to that whole profession. But there's this fear that at some point that AI may become more intelligent than human beings, and then put us in a situation where we become obsolete. Do you have, as the chair of the Federal Reserve, concerns about AI that you wish we knew and would address?
Thank you, Congressman. This is the most exciting opportunity, but with it comes the kinds of risks and challenges that you highlight. We at the central bank need to look at these with a view towards what do they mean for our mandate? What does it mean for our expectations of inflation over the next couple of years and beyond? What's it mean for employment? You told us that's our job. And so we have to look at artificial intelligence and the surge of technology with open eyes about it. I must admit that part of these challenges, I see huge amounts of talent and thinking inside at the Federal Reserve, but I wanted to bring in some outsiders to share a view. So I've created a task force on productivity and jobs to help us think about that connection. We're not outsourcing anything. We're ultimately
Gentleman's time has expired.
We're ultimately going to make these decisions. But American ingenuity has found its way into artificial intelligence, and it's an exciting time, but one that we're not complacent about.
Thank you, Chairman.
Thank you. Chair recognizes the chair of our subcommittee on digital assets, Mr. Stile of Wisconsin. You're recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chairman Warsh, thank you for being with us today. A year ago on Saturday, the Genius Act was signed into law. And with that, a series of deadlines for rules to be promulgated began, and the clock began to tick. You've came into your job confirmed approximately 2 months ago. The deadline for the Fed to promulgate rules is this Saturday. Will the Fed meet that deadline?
Well, it's a fair and open question. I have been corrected. I've not been in the job 6 weeks, but 7. We're racing to put that out by this deadline. I'll just add one other thing, Congressman, without taking too much of your time. I think rulemakings from the bank regulators are best when we have a family fight between and among us, so that there would be one proposed rulemaking for comment. It might not be exactly true this time, but that's my objective, that we'd be coordinated in issuing our rulemakings at the same moment.
No, I appreciate that. I think from this body, I think there's a huge opportunity with stablecoin, in particular, to make sure that consumers are protected. That was one of the drivers of us passing that legislation. There's a lot of work to be done. You're new in your new role with the Fed, but we would like to be updated if, in fact, that deadline is not made. And then, in fact, when those rules will be promulgated, we're all anxiously awaiting. So appreciate your attention to that. Let me shift gears. There's been a lot of talk about AI. Obviously, as any new technology, as you have said, brings forward opportunity, but also risk. One argument, of course, is the labor market could collapse. We heard that offered by a couple of our colleagues. Of course, as we look back at other technological cycles in the United States, we've actually seen standard of living increasing. Jevons paradox tells us that actually as technological cycles come through, we have opportunities for greater employment, in particular if we get the rules of the road right, as in many ways the United States has in previous technological cycles. How are you analyzing your role with full employment, in particular as it relates to this next technological wave?
If this cycle, Congressman, is like the previous positive technology shocks, the U.S. will be richer, will be more productive, there'll be more labor, there'll be more wages, there'll be more compensation. That is if this follows prior trends. This technology shock is likely more significant. This is probably the biggest change in my adult lifetime because it's not just the creation of a new widget. What it is, it's changing the method of innovation and the speed of innovation. And I can't think of a country on earth as well positioned to take advantage of it. So that's on the one hand, but on the other hand, it can lead to disruption. My own best guess is that the advent of the technology will be augmenting existing work, that employees that were there will be more productive. And ultimately, at the end of the day, I don't believe in the lump of labor fallacy. All the jobs that are there have already been created, and the technology will remove some. Well, it might be disruptive in the near term, but it'll create a lot of other jobs. Just to give one example from history, and then I'll close. Who knew at the creation of the internet that the internet would create 1.5 million Uber and Lyft drivers? I certainly didn't. So I want to be very open-minded about the job producing elements of it. But we have a day job, and it's to deliver on price stability and full employment. I've asked this outside task force of a few incredible experts to think hard about it over various time horizons, and we'll keep our eye on making sure we deliver in every one of those time horizons to ensure stable prices and full employment as best we can.
Thank you for that. I think there really is optimism, although there is downside risk. And I think one of the imperative aspects here is that we get the rules of the road right so that the innovation development is occurring in the United States of America and not offshore. One of my big concerns is how the Biden administration looked at emerging technologies in the financial services space, was that they were pushing that innovation development offshore rather than encouraging that here in the United States of America. With 30 seconds left, a lot has been said on the positive numbers that came out today. How does that shape your short-term and long-term outlook with the final 25 seconds?
So it's one data point. The reason I created a task force on data is I don't want to overread or cherry pick data. There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Thank you, cognizant of the time. Appreciate you being here today, Chairman. Mr. Chairman, I yield back.
Thank you. The chair recognizes the ranking member of our subcommittee on financial institutions, Dr. Foster from Illinois. You're recognized for 5 minutes.
Thank you, Mr. Chair, and welcome, congratulations, and I hope that you cherish the scars from surviving the financial crisis that we both suffered through 20 years ago. I entered Congress and the Financial Services Committee in March of 2008, where I was right in the front row there, about 2 meters from Ben Bernanke and Hank Paulson, as they came to Congress to ask for a $700 billion bailout. Watching the sweat drip down Hank Paulson's forehead. So I hope you don't have to go through that. But you know, one of the Fed's most important roles outside of monetary policy is the operation of the central bank swap lines. And these, as you know, were absolutely crucial in preventing the global financial crisis from becoming a global depression. And I think, to my mind, it remains the major reason why the U.S. dollar is the world's indispensable reserve currency, in an area where, by the way, the Chinese are trying to become increasingly competitive. And so the problem, of course, is that right now we have in the White House an occupant who sees his every power as a means of rewarding his friends and punishing his enemies, domestic and foreign. We saw that an example in the Argentine bailout, where he implemented swap lines using the Treasury's Exchange Stabilization Fund. I think he pretty much maxed it out. But to reward one of his MAGA allies internationally with a $20 billion loan at well below market rates, or probably they couldn't get a loan from anyone at that point. And so the question that I have, that when you and the FOMC are operating those lines, particularly in times of crisis, do you see yourself as an agent of the president or as an independent actor?
Thank you, Congressman. I appreciate the question. The swap lines that we put in place in the 2008 financial crisis like you, I think, played a remarkable benefit in trying to mitigate the risks for the U.S. economy. And it reinforced that the dollar is the dominant currency in the world. Now, my judgment as central bank chief is to let the dollar policy be discussed by the Treasury Secretary and leave that to him. But historically speaking, I think the swap lines played a major role. The dollar liquidity swap lines that the Fed has put in place are about the conduct of monetary policy. So those are independent, but I just want to distinguish one thing. The Treasury has separate authorities and can use the Exchange Stabilization Fund for swap lines that are unrelated to our powers and responsibilities.
Right. Yeah, but the Fed's the big dog in swap lines. I mean, the ESF is, I think it's somewhere a little bit north of 20 billion, I think, is the most that they could.
We've been watching Federal Reserve Chairman Kevin Warsh testifying before the House Financial Services Committee, and you can continue to watch the hearing on the Yahoo Finance platform and on our YouTube page. Let's bring you back to regularly scheduled programming.
Everything that comes along with it is independent. Just to go back to the 2008 financial crisis, when all that happened, as you'll recall, the Treasury Secretary and the Fed Chairman, they often had to work in tandem. It's hard to distinguish in crisis times, separate from more benign times, exactly where those roles and responsibilities are. And when we put in those swap lines, when I was a governor at the Federal Reserve, I remember frequent discussions between the Treasury and the Federal Reserve. We have our independent authority, but I don't want to leave you with the impression that in 2008 or 9 we did that without a discussion with the Treasury.
Okay, well, I just, yeah, be very careful of that because you are going to be coming under extreme pressure. Now, let's see, I applaud all of your focus on data, which we talked about when we talked. And in particular, your need for better real-time data. You know, the question of whether we could have picked up the inflation earlier with more leading and real-time indicators, I think is a very valid point. I applaud you for having your committees investigate that. But does this interest also go into real-time regulatory information as well, which I think is really going to be crucial in a world where there's 24/7 banking operations, banks and financial institutions get in trouble fast. And so, are you also going to be looking at the need and benefit for regulatory data on a faster time scale?
Absolutely. I've only been here for 7 weeks. The focus in those first 7 weeks, I must admit, is making sure that monetary policy gets back on track. But many of these lessons learned, like in data, how do we make real-time decisions isn't just as monetary policymakers, it's as supervisors.